City, I'm Brad Smith alongside Shauna Smith, and this is Yahoo Finance's flagship show, The Morning Brief.
Well, stock futures are under some pressure here this morning. Wall Street cooling its rate cut expectations. That is weighing on the broader markets. Let's get right to it. The three things that you need to know this Wednesday morning as we prep you for the trading day. We've got Yahoo Finance's Jared Blickery, Madison Mills, and Frost Supermanian with more.
Nvidia strikes back. The chip maker is staging a comeback after snapping its three-day losing streak. The volatile trading sessions, they had dethroned Nvidia as the world's most valuable company and accumulated a loss over $430 billion in market cap.
FedEx shares are moving higher on the back of its fourth quarter results. FedEx earnings beating on both the top and bottom line. But what's moving the stock higher is actually the company's cost-cutting efforts. The firm saying it's on track to achieve its $4 billion cost-cutting goal, and they expect an additional $2 billion to consolidate its air and ground services. FedEx also announcing plans to repurchase up to $2.5 billion worth of shares in fiscal year 2025.
And Rivian shares surging in pre-market trading after the EV maker inked a big joint venture deal with Volkswagen. The pair will create new EVs using Rivian technology that will underpin both companies' next-gen EVs. In exchange, VW will make a $1 billion investment in the JV, with up to $4 billion in additional capital coming as part of the deal. Now, Rivian stock is up more than 30% in pre-market, but down nearly 50% year-to-date.
Well, our top story of the day is Nvidia. The chip maker is looking to stage a comeback, snapping its three-day losing streak. And Nvidia's slide dented the tech rally that has powered stocks to fresh highs this year. But the last moves and the latest moves are showing the S&P 500 sensitivity to Nvidia's stock movements. At least that's what our next guest says. Joining us now, we've got Barry Bannister, who is the Stifel Chief Equity Strategist here. Barry, great to speak with you here this morning, and thanks for joining us ahead of the opening bell. Going to be another critical trading session, it seems, at least for Nvidia, and that could mean for the broader markets as well here. I mean, just how much weight does this one name continue to have overshadowing kind of the rest of the market machinations?
Nvidia is like the Cisco of our day. If you think about it, it takes about one generation to forget about a bubble. And the average baby boomer was about 41 years old in 1999. They drove stocks up vertically. They loved Cisco. It became the most valuable company. We had extreme optimism, narrow markets, high valuation, day traders with strange names. We even had overzealous prosecutors in Washington. Back then, it was Ken Starr going after Bill Clinton. Now we've got these. So I'm just astounded by the way things are very similar to 25 years ago. And if you get more quantitative, even more so, Nvidia is just the poster child for this bull market.
So then, Barry, what does that tell us about where we're headed from here? Here we are, we're not too far from those record highs. We're under a bit of pressure here this morning, but more so for the broader market. What does this then signal?
Well, the market's expensive. I mean, if you look at the way we calculate equity risk premium, the earnings yield above the risk-free yield on offer, it's at about 2.5. We think it should be about 3. So the S&P is a good 10% above where it should be. There are a lot of other ways to value the market and look at equity ownership as a percent of households' financial assets. These are at record highs. These are at enormous levels. So we're concerned about future returns being lowered by the high level of today. There's no better way to get a low long-term return than to overpay in the current day. So right now we're looking at higher than expected inflation and lower than expected economic growth in the back half. This is a moderate form of stagflation. We don't see any Fed rate cuts this year. And as a consequence, the market can pull back, and that's been our call.
What's the extent of the pullback, Barry?
Well, I wouldn't feel disappointed if it fell 10% to about 4,900. We've been saying 4,750. We know that May, October, not just quantitatively, historically, but in this current context, May, October is a pretty risky period. If you're going to be getting more bullish, maybe think about doing it in fourth quarter. But I I would be cautious, have some protective puts here going into the summer and early fall.
Barry, when you just said we're expecting lower than expected economic growth in the second half of this year, what do you think that is going to hold for the earnings guidance that we hear from companies where, based on some FactSet data, earnings growth for the second quarter is expected to be broad across indexes, 8 of the 11 sectors projected to report year-over-year growth, but it's also going to be about what they're sensing in the macroeconomic environment going into the second half of this year that investors are really going to be leaning on?
To an extent, the things like initial claims picking up, the consumers acting a little tired. You saw the retail sales number, which is mostly the goods side of the economy. But the services side of the economy is red hot, and super core PCE is the part of is half of the PCE core inflation, and that's the one that worries us. But beyond that, I think what's going to happen is net exports are going to be a very big detractor in the back half. I mean, much larger than normal within the GDP figures, and that's because of the strong dollar and the slow growth overseas. But as we go through the year, I think we'll skate by a recession. I think it's just going to be very sluggish. And the big issue really is inflation. That's the number. I don't expect a bad number Friday when we get the PCE inflation. What I think is starting in the June data on July 26th, we'll start to see an uptick all through the rest of the year, and we'll be at 3% by the late third, early fourth quarter.
Barry, going back to what you were just saying a minute ago here, when we talk about some of the pressures that we could see on the broader market, you mentioned the fact that Nvidia could be the next Cisco. I'm curious more so why, just given the valuation gaps that we're seeing, it's not exactly an apples to apples comparison. So what is it about Nvidia that you're seeing that makes you a bit worried that this could end up like the next Cisco?
Well, yeah, when I say the next, they're already what Cisco was back in 1999. So they are the largest company. They are the darling. But the valuation difference, consider that semiconductors are capital goods. They're very small, short cycle, early cycle capital goods. They don't typically get an enormous multiple like you would give to a very high ROIC, low incremental cost company like software, where there's enormous return on capital. Sure, they're getting the build out of AI, but once you build a bridge, you don't need to build it twice. So the build out will not be a continuous process that you can discount over 45 times earnings over 45 years, even with growth. So that's one thing to consider. The other is that if on NVIDIA specifically, it's called the second derivative, the change in the rate of change of analyst EBITDA revisions. That's the thing that we found that guides the stock. So if you look at the year-to-year change of NVIDIA stock, it's the year-to-year change of the revisions in analyst EBITDA estimates. We published a note on this, and that has rolled over decisively 2 quarters ago. So what we think is the stock's year-to-year change will diminish. It'll still be positive, but it looks for a correction, I would say probably in the high 80s by the late third quarter.
And Barry, just lastly here, one of the huge things that we saw with Cisco was a major pullback after the dot-com bubble. Do you anticipate the same type of stock correlation where investors are going to say, okay, who else are they possibly going to sell to? And then you just see a range-bound company for an extended period of time?
No, what happened with Cisco is, and the same thing happened to Microsoft and Amgen and a number of other big cap stocks, is their PE multiple was too high and they earned into it over the course of the next 15 years. So the earnings went up dramatically. As was expected. This happened with the Nifty 50 stocks in the early 70s. They earned very well, but their PE multiples were too high. Their PE ratios, the Nifty 50 in the early 70s, if you look that up on Wikipedia or ChatGPT, that if you look it up, you'll see that those companies had these mid-30s, 40s time multiples. They earned into it over the course of a decade. But what we have today is extreme optimism on new technology. Then it was the internet, now it's the AI. narrow markets, increasingly narrow markets with a high valuation. Equity ownership was very high, and the day traders and all that. I'm just saying that you have to have been there 25 years ago to remember that it was a very similar feeling environment to today.
I was just opening up my E-Trade account back then, Barry. I was just getting things started. I wish I was around for it.
I was a securities analyst and had been one already for 20 years, and it was, or nearly 20 years, and I covered industrial stocks, and so I was very close to the cyclical world.
Still looking 34, Barry. Looking good.
Barry, it's always great to have you. Barry Bannister, Stifel's Chief Equity Strategist. Thanks so much hopping on and joining us here this morning. Let's take a look at FedEx. FedEx is the top trending ticker on Yahoo Finance. Shares are surging this morning after its fourth quarter earnings beat, proving its cost-cutting efforts are working. Now, the shipping giant saying that capital spending declining 16% in fiscal 2024. Its CEO touting, quote, unprecedented results in the current environment. You're looking at gains of just about 13%. We want to bring in Stuart Glickman. He's CFRA's research energy equity analyst joining us now. Stuart, it's great to have you. So I think a lot of this optimism, really what is driving the stock here this morning, has been some of that commentary surrounding FedEx Freight and exactly what that could look like here going forward. What do you think about the potential spinoff there of that business and ultimately what that means for the stock?
Right, Shauna. So yeah, I think that was interesting news that came out last night, that a potential spinoff of FedEx Freight draws a lot of interest because the margins in freight are really quite good compared to FedEx overall. But don't dismiss, I think, also some of the other, I think, positives from the quarter. Revenues did not miss, which is a nice change to see. And to your earlier point, the cost cuts look like they're finally, like the rubber's finally hitting the road there, so to speak. And $1.8 billion of savings in fiscal 24 that just ended with the May quarter, another $2.2 billion coming in fiscal 25. And so the fact that FedEx is delivering on the cost cuts, able to, expand its buyback program, and to your point, possibility for a spinoff, I think makes the stock attractive this morning. And I think that's why you're getting the pre-market bounce.
Transports have been a battered sector over the course of this year thus far. What does this signal about the economy more broadly, at least from the read-through in FedEx's lens?
Right, Brad. So you're right. Transports have struggled. And I think one of the concerns that's affected this space is, volumes, have really struggled to make any kind of traction. In the U.S. business, that continues to be a little bit of the case, where, and even, FedEx's guidance for next year, revenue growth is only supposed to be low to mid single digit growth, right? So we're not talking about, a looming broad macro recovery. I would also point to FedEx's earlier moves from the quarter where they eliminated, for example, 2,000 jobs in Europe, which I think was also indicative of concern that a broader macro recovery, at least in Europe, is not coming around anytime soon, because otherwise, why would you let those folks go? So I do think that the macro picture does look troubled. And so FedEx is doing, for the most part, I think what most companies would do under those circumstances. You cannot count on sort of a broad macro tailwind. So you really focus your efforts on cost cutting. And so far, they've been doing quite well on that front.
So when it comes to the valuation here potentially of FedEx Freight, how much, do you have any idea just how much that business could potentially be worth? You talk about it maybe, or at least in the lens, it seems like for investors right now thinking that this could be a catalyst. What do you think that valuation could look like?
Right. So that's a little bit tricky, but I guess what I would point to is the operating margins in less than truckload freight are generally much better than they are for FedEx as a whole. So, you're getting operating margins probably somewhere in the 20% range for that LTL business. And that compares quite favorably with FedEx Ground or FedEx Express. So I think it's a bit premature to say, to put a sticker price on the value of the company as a whole. But certainly, I think that if you're going to be selling off the LTL business, you're going to be generating a fair amount of operating income from those divested assets, and so that should fetch a decent price.
Stuart Glickman, who's the CFRA Research Energy Equity Analyst, tracking all things FedEx, ticker symbol FDX, moving higher, 13.5% here pre-market. Thanks so much, Stuart.
Thank you.
Certainly. Let's turn now to the auto space. Shares of Rivian popping on the announcement of a $5 billion investment from Volkswagen Group. Now, here's what this pertains. The automakers are forming a joint venture that will focus on creating tech for electric vehicles. The partnership comes amid a broader slowdown in EV sales and is seen as a lifeline for Rivian, which has struggled with cash burn. Rivian is down nearly 50% so far in 2024. Here with more is Yahoo Finance's Pras Subramanian. Hey, Pras.
Hey, what's going on?
Not much. We're just trying to figure out what's up with Rivian here.
Yeah, so basically you mentioned this deal. This is a big joint venture situation here, right? So the money's going to go towards building next generation software-defined vehicles. But basically what this means is, Volkswagen is paying through a JV for Rivian technology. Their zonal hardware design, which is sort of underpins their R1 vehicles, and then also electrical architecture, all the different electrical connectivity, motors, things like that. They're paying for it all. They're going to pay that $1 billion initial investment convertible into stock at some point, plus an additional $4 billion into the joint venture for a commitment of $5 billion. Like you mentioned, it's a big deal for them because of the fact that cash burn was a problem. There was concerns about how they're going to bridge over to their R2 next-gen vehicles coming in 2026. Do they have the cash to get to that point? Now they do, and you have the backing of a major, one of the largest automakers in the entire world.
Is this a win for VW too? And I guess also just in terms of if this partnership is successful, are there other EV makers that maybe could potentially stand to benefit from this too?
So the VW thing is very interesting because I was on a call last night with analysts and VW CEO Oliver Bluma, and the analysts were saying, hey, what's going on here? You're already spending a lot of money on EVs. Why are you now buying more EV tech from another company? Are you double dipping here? What's going on? It's like, no, we're not doing that. We're using our other technology and other VW corporate brands, but we're using Rivian stuff for future vehicles. People have surmised they have a Scout brand coming up, electric adventure vehicles. That could be where the Rivian R2 pops up in the VW world. But you mentioned other companies can benefit from these types of licensing situations. I think there was a Citi note today talking about how Lucid could be the next big sort of beneficiary of this because they've already licensed technology to Aston Martin. They build their own motors, their own electrical architecture, all that stuff, batteries, and they have the know-how to sort of, here's a package for you to build your EV. And I think that maybe there's some overall bullishness in the entire space. Even Fisker, look, they went out of business, but they have valuable IP technology. Like, that could go somewhere.
All right, Pras, thanks so much tracking all things Rivian plus Volkswagen and the entire automotive landscape. Appreciate it. Everyone, we're just getting started on the morning brief. Coming up, Southwest shares are sinking after slashing its unit revenue estimates for the second quarter. We'll break down some of the top trending tickers next. Plus, it's been a big week for healthcare stocks. We'll speak with a strategist on how you can play the pharma space later on in this hour. And then stay tuned for our 10 a.m. hour catalysts, where Shauna and Maddie are going to speak with an analyst calling Uber, quote, sleeping giant. All this and more. You're watching Yahoo Finance.
Time for some trending tickers here. Let's kick it off with Southwest. You're looking at declines of nearly 5%. The stock falling after the company slashed its revenue guidance for the second quarter. Now Southwest is now projecting a drop of as much as 4.5% in revenue per available seat mile. That's an adjustment from the previous expectations of 1.5% to 3.5% decline. So now they're expecting a larger decline here. The company is saying that this is primarily driven by complexities in adapting its revenue management to current booking patterns in this dynamic environment. They also went on to say that the company continuing to expect an all-time quarterly record for operating revenue in the second quarter of 2024. But again, a lot of this coming down to demand, ability to meet demand. We know when it comes to what is available in terms of planes and supplies there, that has been a critical issue here for many of these airlines over the last couple of quarters, and really ultimately what it means for meeting some of those initial projections in the second half of next year, and of course looking ahead to 2025. But again, a lower guidance here is clearly taking a hit with the stock. So a lot of people asking just ultimately whether or not this is a Southwest specific issue, or if this is something that is also signals issues elsewhere within the airline space.
Yeah, one of the low-cost carriers here. Perhaps this should have been anticipated to a certain extent from some investors out there, especially if you continue to see economic data prints like we did in CPI, where airfares were actually continuing to decrease, continuing to decline. So that is one point that I would actually continue to remind people about, is that some of the economic data had already showed this in the tape, if you will, for Southwest Airlines and some of the other low-cost carriers here. What's also worth noting here is that it's not going to affect the 9th consecutive quarter that they were projecting of record revenue. They noted that within this filing here. The company expects second quarter revenue per available seat mile to decline in the 4% to 4.5% range, as we were mentioning here. But they're also noting that this is not going to impact the expectation of an all-time quarterly record for operating revenue in the second quarter of 2024. This is something that they had talked about in their most recent earnings call as well, and so that's not going to be impacted. However, shares certainly taking it on the chin, at least here this morning. And then the other thing to really continue to keep in mind here is some of the fluctuations that they could see in routes that consumers are expressing more propensity to travel to, and weather plays a huge factor in that too. And so even as we're kind of looking across the airline industry right now, and many of the airlines in a few weeks going to be closing the books on their quarters, the heat waves that we're seeing across the country, that could have another impact on where you do see travel cancellations, booking cancellations, or even pushing those out even further here too. So that's one thing to consider, especially as we get the outlooks when they do report earnings for this current quarter as well.
All right, let's take a look at Whirlpool. It's another stock that is trending here on Yahoo Finance. Shares are surging. Look at that, up just around 18%. The company this comes after German engineering group Bosch is reportedly eyeing a bid for Whirlpool. Now, this is according to a report here from Reuters. In a statement to Yahoo Finance, Whirlpool is saying, quote, "As a matter of policy, we do not comment on market rumors or speculation." So lots of questions about the odds of this happening and why this could potentially make sense here for Bosch. Now, this would significantly help boost Bosch's home appliance business, obviously at a time when there is much competition within the space, increasing competition within the space when it comes to what Whirlpool could potentially add to Bosch's business. It could be viewed as a catalyst here for shares going forward, for their business going forward. But again, we're looking at gains of just about 18%, Brad.
Yeah, Whirlpool had been offloading certain parts of its business as well. Anybody who listened into the last earnings call heard them talk about executing on the announced sale of their 24% stake in Whirlpool of India. They still retain about 51% ownership, but it does beg the question of what parts of the business they're open to evaluating a potential sale, if not the entire business. So that is one of the areas, especially considering what they've been talking about within the demand that they're seeing, especially here in North America. They continue to see that industry volume being soft, at least during this past first quarter, promotions remaining elevated, persistently high interest rates, and then that continuing to put pressure on housing affordability and overall consumer discretionary spending. What's that mean? Less fridges, less washer dryers that people are perhaps replenishing as they're getting into some of, or historically would have been getting into some of those new homes and pads or cribs.
Yeah, and I mean, and take a look at the stock, right? We just had some of the longer term charts up on the screen there. Year to date, this is a stock that's tremendously underperformed the broader market. You're taking a look at the last 12 months, not much of a different story there. You're looking at a decline of nearly 40%. So they need to turn around the business. They need to figure out something that would look attractive. So maybe, you never know, but maybe Whirlpool's board would entertain and is entertaining this offer if there's one.
Yeah, it's true. All right, let's also talk a little General Mills, where some people might, well, anyway, I was going to try and make a correlation to Whirlpool. There is none. Anyway, General Mills shares falling this morning after reporting mixed fourth quarter results and issuing softer than expected guidance. The Cheerios maker also seeing sales fall 6% from a year ago. Shares are down 6% right now. And the cereal business, I mean, I always do a Command F for cereal just to see what they're saying about that. They did mention that within the North America retail segment, net sales were down about 1% to $12.5 billion. Organic net sales 1% below year ago results. That actually grew double digits. And so it's interesting. I mean, pet seems like one of the stronger elements of the business right now, especially as you're kind of evaluating what North America retail for them is looking like in that pullback of about 3% for the full year as we're tracking at this point.
Yeah, I think when you take a look at General Mills' business, the fact that they did come in below expectations on the guidance, lots of questions about what is going to happen to this business, at least in the short term. They're under a tremendous amount of pressure to lower prices. At the same time, if they do that, then they need to significantly boost volumes. And you're doing this at a time when millions of Americans are still under a tremendous amount of pressure from very sticky and persistent inflation. So again, it is a tough setup for a name like General Mills, and there is some caution. I was looking at the quick analyst commentary here, or reaction, I should say, to these results, and there was some speculation that we could actually see a softer second half coming up when it comes to the pet business, and maybe it's not going to be enough to offset some of the weakness elsewhere. So again, they're under a tremendous amount of pressure to lower prices. They also need to boost volumes and to offset some of that pressure on margins. So we'll see whether or not that can be done.
Seems like they need some new ideas, and they know it. They said they plan to drive even more of the reinvestment in exciting growth ideas that meet evolving consumer needs. So I don't know what that looks like. You've already got Honey Nut Cheerios out there. What more investment and innovation is there?
And there you go. All right, we're just minutes away from the opening bell on Wall Street. 2 minutes away here. You've got all three of the major averages under a bit of pressure. We'll be right back.
Oh yeah, that's the opening bell on Wall Street and in Midtown Manhattan at the Nasdaq. You've got a great group of bell ringers there, both on your right and left side of the screen. AeroVironment ringing the opening bell at the Nasdaq, AV. And SoundPoint Meridian Capital, SPMC is the ticker symbol there. Lots of claps, lots of cheering, lots of funfetti. All right, that is the opening bell. Let's do a quick check of the markets as we're taking a look at the Dow, the S&P 500, and the Nasdaq. The Dow right now begins the day lower by about 300 points, equates to about 0.75%. The S&P 500, you're seeing that hold on to gains out of the gate here this morning. It's up by about 0.4%. The Nasdaq Composite ripping to the upside right now. It's up by about 1.25%. We'll see if it can hold on to that.
All right, let's get over to Jared Blickery. He's just over on the other side of the studio at the Interactive. Jared, what are you looking at?
Right here, I am looking at Bitcoin this morning. We've had some volatile action recently, but not this morning. You can see it's up about 0.5% over the trailing 24 hours. I want to look at a year-to-date chart so we can see the consolidation that's been happening across at these highs. So we have basically from the high 50,000s all the way up to the highs about 73,000, and we are at the lower end of this range right now. So if everything continues the way it's been going for the last few months, you would expect it to retrace to the top. Now, if it breaks down, you're going to see some people saying, well, this is an M top, but it's too early to call that right now. You need to get a decisive break below about 58, 57,000. That happens, that sets up 45,000 as the next target. And what could be the catalyst here? Well, over in Japan, Mt. Gox, that firm, that crypto firm that went south about 10 years ago, they had a bunch of Bitcoin stolen, about 700,000. 140,000 are going to be distributed by the trustee. That could come to the market. That could result in a lot of selling, and that could happen in the month of June. It could happen in the month of July, but sometime this year we are expecting that. So that is a catalyst, a potential catalyst, and a risk that we keep in mind. But let me just show you the longer-term technicals. Here is a 5-year chart of Bitcoin. I'm going to compare Bitcoin to some of the other cryptocurrencies that we have. What you see here is we are just consolidating. That the consolidation area is really small that we were just looking at on this longer term chart, but it is higher than these highs we had in 2021. Compare that to Ethereum. Here we have a lower high here, and this is another consolidation area, but just at a lower level. And then you take another token like Solana, very similar to Ether, but just a little bit lower itself. And this continues down the line. And when you get to Cardano, you can see it's still in the bottom end of its range here. So not all crypto has come back, and we have a lot of laggards. It kind of reminds me of stocks, how you have stocks like Peloton that just haven't been able to bounce back the way Microsoft and Netflix have. So there is that dynamic going on. But also I want to point out that another potential bearish impulse or headwind against these cryptocurrencies is the US dollar index, and that is heading higher right now. This is a year-to-date chart. This is the highest level for the dollar in about in about 4 weeks. And if it were to breach these highs here, that would probably put some downward pressure on cryptocurrencies, commodities, international stocks. We're not there just yet, but we want to keep an eye on it, guys.
Indeed do, and we know you will. Jared Blickery, thanks so much. Appreciate it. Well, Chipotle's 50-for-1 stock split is officially in effect. This is the burrito giant's first stock split and one of the largest ever in the history of the New York Stock Exchange. Yahoo Finance's Brooke DePalma is here with everything you need to know. Hey, Brooke.
Yeah, good morning. Chipotle shares are falling this morning, down roughly 3% after the stock split. This morning, shares of Chipotle were over $3,200 as of Tuesday's market close. Now shares are trading around $64 per share after the company issued 49 additional shares per share owned as of market close on June 18th. Now, 3 factors worth noting here. A stock split makes shares more accessible to investors and to the company's employees. On the other hand, one expert warned to Yahoo Finance that the stock could be exposed to a little bit more to some level of volatility at this share price. And lastly, stock splits are purely cosmetic with no impact to fundamentals, but they are largely a sign of confidence from the company. Shares also do tend to see higher returns following stock splits. Year-to-date, shares of Chipotle before market open were up around 40%. If you take a look at another company that also conducted a stock split earlier this year, Walmart, well, shares of the retail giant are up around 11% year-to-date.
in the last 3 months after it conducted its stock split back in February. Now that's compared to the S&P 500, which is up only about 5%.
All right, Brooke, thanks so much for breaking that down for us. Again, Chipotle, a stock to watch here in today's trading day. Let's take a look at the broader market. We're seeing some pressure across the board as we're just about 5 minutes into the trading day. A lot of focus has been on tech. You've got Nvidia shares, at least here at the open, under a bit of pressure, off just about 0.3%, giving back some of the gains that we saw yesterday. Our next guest saying that it might be time to rotate out of some of those larger cap names. We want to bring in Matt Stuckey. He's Northwestern Mutual Wealth Management's Chief Portfolio Manager. It's great to talk to you. So let's take a step back. Talk to me about what you're seeing here, some of the caution maybe that you're warning about when it comes to large caps and what investors should be doing today.
Well, really, our caution towards U.S. large caps is a function of a little bit of caution towards the economy here. We still are in the camp that the end destination for what's been the fastest hiking cycle from the Federal Reserve in more than 40 years is ultimately some form of a mild recession. And when we're looking at different asset classes on the equity side of our portfolios, U.S. large cap expectations, or what's built into the price, don't give us a lot of compensation for that thesis on the macro side of things. And what I mean by that is if you look at 2024, 2025 earnings, they're expected to grow double digits. And against those double digit growth rates, we're expected to pay 22 times 24 estimates and about 20 times 2025 estimates. That's a full valuation, not a lot of compensation for if something does go bad with the economy.
Yeah, and that's what we were talking about a little bit earlier on, trying to figure out if we did see some volatility or at least a worsening economy in the second half of this year, how that would translate through to valuations. What are your anticipations?
Well, usually something has to give. If the economy starts to falter and earnings are under pressure, price tends to follow that as well. Looking at the various macroeconomic indicators that we follow, I just can't stop looking at leading economic indicators. And I know they haven't really played out as they have in historical cycles, but just looking at the actual index today, it's down almost 15% from its highs. Typically we've seen recessions historically if it's off just 10%. There's only been 3 other times in the last 80 years where it's been down more than 15%. And that was the recessions of 1973, 1980, and 2007. So certainly there's some warning signals here that, we can probably rotate out of asset classes that are expecting continued growth, soft landing, and acceleration of the economy, and into things that give us a little bit more defensiveness in our portfolios or don't have as egregious expectations built into the price on the equity side.
And what would some of those investment opportunities be?
Well, I think U.S. small caps can make some sense here. And typically it's a little bit funny to recommend that, given that they're a little bit more economically sensitive. But, U.S. small caps trade at 8 times trailing cash flow. That is a recession level valuation that you just don't see anywhere else across the equity investing side of things today. And given our view that what we're likely to see on the recession side of things is more mild in nature, that the Fed's going to likely be able to cut quite a bit. Typically we see U.S. small caps respond positively to those effects. So there's a little bit of catalyst on the other side of all of this that we think is attractive, and it's overweight in our portfolios because of that.
I guess boiled down as well, though, is the case for small caps just that it really hasn't participated in the rally thus far, and that's the area where we could potentially see the next, upward trajectory or trend higher?
I think that's part of it, but I also think that thinking through the next kind of leadership cycle as the economy moves past this economic expansion and starts another one, usually leadership also changes in the markets. And U.S. small caps tend to be earlier in an economic cycle in terms of demonstrating outperformance, and we want that well represented in our portfolios.
Now, when it comes to some of the valuation comparisons that have been made here between a lot of those AI stocks, when it comes to maybe the excitement surrounding Nvidia and comparing that to what we saw 20 plus years ago with Cisco, you're talking Barry Bannister over at Stifel about this at the top of the hour. I'm curious what you make of those comparisons and whether or not there is some sort of warning sign or signal that you are seeing from the massive run up in some of these AI names.
Well, since you mentioned Nvidia specifically, I think it's a little bit different than we saw in the late 1990s. Nvidia certainly has the margins, the cash flow, the earnings, and from my perspective, the question is not so much really the valuation today, but more so, is the return on investment of all of this AI infrastructure going to keep demand levels into the future to support the stock? We just don't know the answer to that because we're in kind of more of a test and learn phase across corporate America as it relates to artificial intelligence. Really on the product deployment side and the return on all of this investment, that's when we're going to know whether or not this valuation is sustainable. And you can probably apply the same kind of logic to a lot of the other AI winners out there. We're of the belief that artificial intelligence is for real, that productivity gains are likely to be quite strong from this technology. We just think it's further out than what we're likely to see in 2024, even the front half of 2025.
And so if valuations are getting ahead of their skis a little bit on that, then about how long could you expect for the actual benefits of the technology to be realized, and then the companies actually grow into those valuations, I guess, over realized kind of appreciation of that technology, IRL?
I think it's more of a 2+ year out kind of framework that we're thinking about with that. And that's well beyond the window of where we see some macro pressure enter into investor mindsets. And keep in mind, these aren't exactly low beta names. And so despite a strong story to tell as it relates to the deployment of this technology, they are volatile stocks. And so, just be careful in terms of how much exposure you have in your portfolio to some of these positions, because despite a good story that's behind it, it wouldn't be surprising to see them move around quite a bit if the macro gets a little bit rocky from here.
Great insights. Matt Stuckey, Northwestern Mutual Wealth Management, Chief Portfolio Manager of Equities. Matt, thanks so much for taking the time here today, just after the market open. Coming up, it's been a big week for healthcare stocks. We'll speak with a strategist on how you can play the pharma space next.
A wave of developments in the pharma industry this week capturing Wall Street's attention. We've got Eli Lilly's diabetes and obesity drug show positive results when used to treat sleep apnea in obese patients, sending shares of companies that make machines for sleep-related complications like ResMed and also Inspire Medical. Those shares were under pressure this week. And Novo Nordisk also getting some positive news for its weight loss drug after getting approval in China. So here are what the top ways to play this sector. We want to bring in Jared Holz. He is a Mizuho's healthcare equity strategist joining us now. Jared, it's great to see you. So if we just take a look at obviously the excitement surrounding these drugs within the pharma space and exactly what that is going to do to stock prices. Clearly, we've seen a run up in Eli Lilly. We've also seen a lot of that excitement play out in Novo Nordisk. I'm curious from your perspective, how much of this hype and excitement has already been priced in to shares at this point, or whether or not maybe these two stocks still have room to grow?
Great to be here. Thanks for having me. I mean, that's the real question here. I mean, these have been monster stocks for the past few years. Another banner year for Eli Lilly, up over 50%. Novo Nordisk up over 40%. Still think there's room here, though. I mean, the one thing that I keep on coming back to when looking at both of the stocks is kind of what the supply-demand metrics look like for the GLP-1 market. And we're still in, I think, the infancy stages, considering that it's only been about a year since both drugs have been on the market for obesity specifically. And then we talk about all the demand in the market that seems, at this point, unlimited. Plus, you've got all these different catalysts for, not curing, but at least addressing all these other underlying medical conditions, which make the drugs even better. So I think it's very hard to kind of predict either name from a valuation standpoint alone. But I do think the news flow over the next 6 to 12 months and even into next year are going to be potentially prolific, because we're going to be talking about more and more indications that the drugs satisfy.
With that in mind, I mean, investors are always looking at the healthcare space for the next major breakthrough or scientific advancement. What is that beyond GLP-1s at this juncture? And is it clear which company is pioneering that?
It's not really clear at all. I mean, I think in some respect, the next, innovation wave could still come as a result of the GLP-1 class, because both companies are looking at their technology for use in neurological diseases, including Alzheimer's disease. And we're going to have data on that roughly a year from now, maybe a little bit later than a year from now. So as I kind of look across the complex in biopharma, the GLP-1 still might be, the center of innovation in terms of what you're talking about, the next leg or, the next exciting area. Because outside of this, I just don't see market opportunities when we talk about dollar or revenue opportunities being anywhere near as significant as what these are going to do.
So, Jared, when it comes to, I guess, the potential here as to be the catalyst then for other names within the industry, we spend so much time, and rightfully so, over the last 6, 12 months, I'm sure for you a lot longer, talking about replacing a lot of the emphasis on Eli Lilly and on Novo Nordisk. Are those the two top plays within the sector, or are there other names that maybe investors should be taking a look at here that could kind of ride the coattails, so to speak, and also get a boost from some of this GLP-1 excitement?
Well, yeah, I mean, I think for me, Novo and Lilly are still going to be the top two. As long as they're dominating in this kind of section of the market, it's really tough to, not ride these a little bit longer. As far as other players in the GLP-1 market that might emerge that are of interest or intrigue to investors, I think we're still trying to understand from Amgen what their monthly GLP-1 data is going to look like. That's going to be available sometime this year, not precisely sure when, but they're looking at, the use of the weight loss drug on a monthly basis. That's versus Lilly and Novo weekly. So that's one to kind of watch out for. I mean, I've been pretty bullish on Merck all year, given valuation, given the fact that they seem to be doing a lot of smart things from a business development standpoint to kind of dilute the effect of Keytruda losing patent exclusivity closer to 2030. That's been the big concern, that the lion's share of their revenue is going away. But they've done a lot of smart things in terms of acquisitions and otherwise to kind of make sure that that erosion is not as extreme. And I think AstraZeneca is probably fourth. So I think Astra and Merck as kind of like still very solid quality names in pharma that you can play. They don't have huge GLP-1 exposure, but I think Amgen's going to be interesting. I don't have a strong view on it. We really haven't seen a lot of data. Companies seem super bullish on it. That could be one clearly worth watching into the second half.
And that's interesting because it strikes a key thought that investors should be remembering as well is when companies see a windfall of profits or success in one drug or one part of the business, they typically take some of that or at least earmark or allocate a certain part of that capital to go back towards, okay, what are the patent roll-offs that we're going to be experiencing where we need to go out and buy new companies who have patents that we could secure for, a decade plus. Are there clear companies from your analysis that are going to have to do some of that heavy acquisition that could impact margins in the near term?
Yeah, it's a great question. I mean, I think about M&A almost every day, kind of doing this job, and how significant of a piece of the puzzle it is for pharma. And I'd probably argue that most companies in large cap biotech and pharma are kind of perennial buyers. I think Lilly and Novo, of course, their backs are up against the wall less than all of the other peers. Pfizer's done about $60 billion worth of deals over the past couple of years. I still think there's potential for a little bit more out of Pfizer into kind of like the second half of the decade here. I think Merck is still a buyer. I think you could see additional activity out of Sanofi, out of Amgen. It's really anyone outside of the top two that's going to have to continue to, put dollars to work with respect to M&A. And I would include Johnson & Johnson there too. They've been very active in medical devices, but have not done a ton in biotech. So maybe, once their talc situation is more resolved or looking like it's going to be resolved and they kind of know the pathway a little bit better, I would be shocked if they didn't do something in the next year or two.
Yeah, a massive case that's continued to be a multi-year effort to try and get passed for Johnson & Johnson with regard to the talc lawsuits and investigations there. Jared, thanks so much for taking the time here with us today. Jared Holtz, who is the Mizuho Healthcare Equity Strategist. Appreciate the time.
Thanks so much. I appreciate it.
Certainly. Guys, coming up, some ride reservation changes coming to Disney World. We're breaking down what you need to know if you want to skip them lines. That's right after this break. Don't experience the magic? Walt Disney World in Florida is revamping its ride reservation system. Starting July 24th, Disney hotel guests will be able to book ride reservations up to a week ahead, and other park attendees can book up to 3 days in advance. Now, currently, visitors can really only book spots on the day of their visit. I haven't been to Disney World since high school, I want to say. So
Yeah, because it's so expensive.
I've been barred from the magic for a little bit. I've driven by Disney World when I was in Orlando last year, but it seems like people are still having a fun time there at what they deem the most magical place on earth. But it's gotten a little bit more expensive.
Yeah, I was gonna say they better be having a heck of a time there, just considering how much it costs. I'm actually shell shocked right now, and I have 2 young kids, so I guess maybe I'm going to be going to Disney World sooner than I would like to admit. And the fact that people are paying this much, we're not even getting into the news of the day. The fact that people are paying this much to enter the parks is just something I'm still wrapping my head around now. If you want to pay even more here in order to reserve your place in line, maybe if you are, I guess you can rationalize that you're already paying so much, so you might as well capitalize on the time that you have there. But I think this makes sense, and this also goes back to what we have seen Disney do over the last several years. They're trying to make their parks more efficient. They're doing this because they see it ultimately driving revenue here in the longer term. So they're trying to cut down on crowding. They see that potentially helping revenue here over the next several quarters, next several years, how much people are willing to pay for these multi-passes and to cut lines. I think that is what is up for debate right now, exactly what demand is going to look like. But again, when you take a look at the crowds of people month after month at Disney World, and the fact that people are continuing to spend and take their trips to Disney World, even in this macroeconomic environment, it does say something.
Right, even in this economy. I was looking at some data from the Points guy, actually, and this is the 2023 data. We'll see if we get, at the end of 2024, some aggregate costs. But ultimately, they said excluding taxes, the total came out to, and of course, this includes the 2-day tickets, granted entry into Disney's Hollywood studios on one day, Magic Kingdom on another day. Total came out to $282.55 a person for everyone 10 and up. And then, so ultimately, collectively spent $1,100, just south of $1,200 for 2 days of Disney World tickets for 4 people.
That's a heck of a lot.
That's actually on the low end of what I've heard.
Really? Well, it still sounds like a lot of money to me. All right, keep right here on Yahoo Finance. We got much more coming up at the top of the hour. We've got some breaking housing data out for you. We're going to cover that and more on Catalyst next. It's 10 a.m. here in New York City. I'm Shauna Smith alongside Madison Mills, and let's dive into the catalyst moving markets today.
A peek into the housing market. We've got May new home sales signaling that high mortgage rates could be keeping some buyers out of the market. We're going to dive into the latest on that data.
Nvidia's a wild ride. We've got Nvidia ticking slightly higher today after rebounding yesterday, closing up nearly 7%. The stock has moved double the entire market cap of JP Morgan in just 5 days. We're going to discuss why the recent swings in Nvidia's stock price could have a big impact on broader markets.
And Apple's AI play is more privacy-focused than its big tech competitors. Could this be a boon for Apple's stock moving forward? We're going to discuss.
All right, let's kick it off with the breaking news that we have at the top of the hour. The latest data that we're getting out on housing, new home sales falling just over 11% here. Most recent month, the month of May, falling to 619,000. That was just below what the street had been anticipating. When you dig into this data here, taking a look at how it compares to prior months here, median new home price, that fell nearly 1%, down 0.9% on a year-over-year basis. The average new home price, or median new home price, is $417,400. That was down from average selling price of $520,000. Houses for sale in May rising 1.5% on a month-over-month basis. But again, the decline here from the previous month during the month of May is really what is capturing headlines right now, Maddie.
Absolutely, Shauna. And it's interesting when you look at what we're seeing in terms of the mortgage application data for new homes. That has been up despite what we're seeing broadly. And that's because builders are kind of buying down mortgage rates. In some cases, folks getting mortgage rates as low as in the 5 ranges. And that is inflating the numbers when it comes to applications. That might be one of the potential reasons we're seeing kind of a difference in the data when it comes to new home sales versus what we're seeing in the application space. Housing also obviously a big drag on the broader GDP data, a key metric that we look at when looking at the strength of the overall economy. And this could give us an indication of how the housing market might be impacting GDP moving forward here. Taking a look at the broader markets, though, I want to see how we're doing here. Still looking like the broader market's moving to the downside. That is already continuing the market movement that we were seeing earlier today, though it looks like the Nasdaq is starting to flip into positive territory right alongside Nvidia, Shauna. Well, we're going to turn it now to that big story of our day, the tech trade. Nvidia shares bopping around this morning. We saw a brief sell-off earlier in the week, a little bit of downward pressure earlier today. Now that stock moving back to the upside. All of that movement highlighting the anxiety behind the AI rally. So how should investors be positioning amidst that uncertainty? Joining us now, we've got Stuart Kaiser, Citi's head of equity trading strategy. Stuart, great to have you in person. Thanks for being here. So Nvidia, we got to talk about it first. Bopping around a lot this morning. What is the central thesis that investors need to be focused on when it comes to the Nvidia trade?
I mean, I think when people are gravitating towards Nvidia, I think the logic is I believe in the AI theme. I'm not sure who the winners and losers are going to be, so I need to buy the stocks that are like the pipes of the system, essentially. So no matter who wins at AI, they need these higher-end chips, and that makes AI and Nvidia kind of an easy match. You might throw Microsoft in that pile as well, just because they're able to demonstrate revenue kind of related to AI. But this actually harkens back to even the crypto period, when you might not believe in Bitcoin, or you may believe in Bitcoin, but people need higher-end chips and servers to deal with Bitcoin, so you can invest in the pipes without kind of taking a view on the theme itself.
Has anything changed in the narrative?
I mean, I think the Nvidia narrative, the AI narrative, I think, yes. I think on Nvidia, it's a valuation discussion. Valuation's gotten high. You've also had this series of very large beats versus the consensus. So there's some concern that you get kind of long in the tooth, and where does that go? On the AI theme more broadly, I think coming into the year, people wanted to broaden out that theme. They wanted to go beyond Nvidia, either to other semi stocks or into software AI, or even into power generation, and kind of play those next 2 or 3 levels. Unfortunately, by and large, that stuff hasn't worked that great, and there's been a lot of single stock risk around it. And I think what you're probably seeing the last couple of days is Nvidia sold off a bit, and people said, you know what, let me just go back to the clean and easy AI trade and not try to get cute with these other things.
So does that mean that investors are seeing more returns when they invest broadly with something like the QQQ versus trying to stock pick in the AI space?
That's been our impression. We have a list of about 35 AI winners, so to speak. Only 13 of those stocks are up year to date. Mm-hmm. So it's been hard to kind of pick the winners. And even beyond that, there's 8 stocks in that basket that are down 25%. So not only has it been hard to pick stocks, but if you've been wrong, you've kind of been really wrong. Mm-hmm. So kind of diversifying the AI theme hasn't worked as well as just being long twos are being long Nvidia and kind of the known winners, even though the valuation has gotten a little challenging.
Stuart, I'm curious what you make of the concentration debate. There has been much said about, hey, this is a huge risk to the market, the fact that there's only a handful of stocks that's really driving much of the momentum. And then many have kind of taken a step back, many of your peers on the street, and you included, and just kind of evaluated kind of what we have seen in the past and maybe what that could signal. So is it a risk to the broader market, or maybe have some of those fears been overblown?
I mean, it's a little bit of a risk just in the sense that, you know, a lot of the returns are coming from a small number of stocks. So either those stocks need to keep performing or you need a significant broadening out. But to your point, if you look back historically, this is kind of how equity markets behave. You know, over any 12-month period, you're going to have 40 to 50% of returns come from just 10 stocks. So there's a theme, a trend, you know, a shift going on in the markets that tends to favor these winners. Momentum does well and those stocks do well. I think the last 12 months has been obviously a little more than at 40 or 50%, and that's got some people concerned. So it worries you a bit, but again, it's not unprecedented. So I think we're trying to be a little more balanced about it. Last year, our takeaway was the reason you have concentration in price returns is because you had concentration in earnings growth. There just wasn't a lot of companies and sectors generating earnings, so people gravitated towards them. That drove narrow leadership. We expected that to broaden out a bit this year. It sort of trickled down. It hasn't really broadened out. We're hoping that it will ultimately happen later in the year, but yeah, it's been fits and starts on that side of things.
Given that, what differences are you seeing in how kind of institutional hedge fund investment is positioning for a potential broadening out versus retail investors?
Retail, it's a little hard to say because they tend to be more single stock pickers. Our view on broadening out was just to go to S&P 500 equal weight. So you're kind of broadening out a bit, but you're still staying in that larger cap kind of investment grade type cohort and not go all the way down to that Russell 2000 small cap. And the logic for that was that Russell has a lot of growth and interest rate risk that you don't need to take on right now. You can just go down to S&P equal weight and do that. And I think if you look at how markets have been performing, I think institutions are generally doing that. Yeah, they're broadening out, but they're broadening out very selectively. They still want to be in a stock that if we do get this long-awaited recession or if the Fed does stay higher for longer, they're not too exposed. So I think that's why it's been a trickle down. People are being very methodical about kind of how they move down the cap structure, and they're not generally doing it into lower quality stocks, I guess you'd say.
Stuart, earlier this week, a pivoting conversation just a bit and focusing maybe on the econ data that we have been getting out over the last several weeks. And earlier this week, as part of our morning brief newsletter, we focused, our chart of the day was on Citi's economic surprise index here and what you guys have been seeing. And for those who maybe aren't familiar with it, it measures just the rate, I guess, that some of that econ data is coming in better than expected. But it's actually hit its lowest level that we've seen in more than a year. I'm curious what that signals to you and maybe what investors should be sussing out from that reading in terms of where we could be heading or some of those risks.
Yeah, I mean, I think we try to balance the surprise with the underlying level of growth. So I think what you've seen, the reason surprise has gotten negative, I think, is because consensus has revised up their numbers as the recession hasn't materialized. So you kind of set a higher bar from consensus. Now the data has been coming in below that higher bar since early May. So it's concerning just in the sense you have negative surprise on hard economic data, and that's the stuff that would go into GDP, as well as like soft economic data, which is more your survey stuff. The level of growth has also slowed, but it still remains kind of solidly positive. So I think now you're looking at that surprise data and you're saying, all right, maybe expectations got a little ahead of themselves, or maybe I'm getting a little warning sign here that I should prepare for a deceleration. From an investor's perspective, that just tells us risk reward kind of isn't as clean as it was early in the year, because we went from a period of low expectations with data coming in better than expected to now higher expectations with data coming in a little bit worse. And I think you just have to respect that and say, you know, maybe this is a time for me to be patient when I'm looking at things.
So what's the next big data point that you think will be the big catalyst for the market? Is it going to be PCE, or are you looking to labor as always?
I mean, PCE matters just because it matters to the Fed. The fact is we have PPI and CPI already, so the market has a pretty good idea of where that PCE number is going to come in most likely. Labor market for us is the key to the markets. You know, our general view is you want to run long your U.S. equity portfolio unless and until you get a significant slowdown in payrolls. And by payrolls, I mean, you know, non-farm payrolls and claims. There's a lot of little, you know, cracks under the surface and more nuanced measures of labor. But yeah, for us, it's payrolls next Friday, unfortunately, the day after the 4th, which is unfriendly.
Tough for you and your team, right, Stuart? Yeah.
Well, you know, it's a Go America moment, so we'll just hope the data comes in strong.
There we go. Stuart, it's great to have you. Thanks so much for making the time to join us here in studio. Stuart Kaiser, he's Citi's head of equity trading strategy. Thanks again.
Thank you.
Let's turn now to Rivian. It's one of the top trading tickers on Yahoo Finance today. Shares are surging. Look at that, up just about 30%. The move higher coming on the heels of Volkswagen saying that it's going to invest up to $5 billion into the EV maker as part of a software development partnership. Now, Rivian shares are down almost 50% so far this year, so we want to put that in perspective for you. But could this be a major catalyst for the EV maker? And also, what does this tell us about VW's ambitions? We want to bring in Tom Narayan. He's RBC's global autos analyst. So, Tom, we can clearly see the excitement play out on the street when you take a look at the pop that we're seeing in shares of Rivian. I'm curious, though, what your first reaction is to this partnership.
Yeah, the first reaction is obviously this is great for Rivian, right? They get a cash infusion that kind of lets them fight another day, takes them to R2, a couple of years, it lasts longer. The question is what this really is for VW. And that's ultimately the question here. They've had their own challenges with software. So we understand how doing a JV like this, they get to use some software that's already up and running, some labor from Rivian that's already there, and they only have to pay $2 billion into the JV. The question is, why do you then need to buy $3 billion worth of Rivian stock? So we suspect that's part of the deal to get it done. Maybe they see some upside in Rivian shares, just like many investors clearly do today. But that's really where the question has been coming in here. Like, what is really in it for VW to spend $5 billion? Why did they need a big stake in Rivian if all they needed was software, a $2 billion contribution? But for Rivian, this is obviously great news. It doesn't necessarily answer the question of will they be able to get to profitability on their car business, et cetera, but it lets them fight another day.
Okay, so if it lets them fight another day, that's really interesting to me because if you look at the details of this deal, it says something like up to $5 billion, right? So there's a little bit of a potential out for VW here. Given that, do you think that that up to $5 billion is kind of a drop in the bucket, or is it something substantial that, to your point, VW kind of needed?
Well, for Rivian, yeah, that for them, they definitely needed the cash. I think they lost something like $5 billion this past year, and they have $9 billion of liquidity. So if you keep losing that amount, then you run out of cash. So they're getting $3 billion of a cash infusion from VW. The other $2 billion just goes into the JV. So it lets them kind of last a little longer. I think that's the way to look at this. But certainly, if they don't reach profitability, and they keep losing cash, billions of dollars, it's really more of extending the life of the company and their endeavors. They're losing, $38,000 per car they lost last quarter. So as long as that keeps happening, it doesn't matter how much cash you keep putting in, they keep losing it. And the other point I would make is I don't think VW would come in and infuse more cash. I think this is a one and done type situation. It's happening, like you said, over many couple of years. I think in the event Rivian doesn't work out, I think VW would just take out this JV and use it on its own, So I think that's the way to put things in context.
Tom, I think a lot of people are asking, I guess, how confident they are that this partnership is ultimately going to work. We've seen failed partnerships, especially within the auto space in the past, just given the merging that we're going to see of cultures and how various companies do things. How confident are you that this is actually going to work out well for both companies involved?
It's a good question. I don't have, either way, it's very 50-50, I guess. I like the JV. But I do think ultimately, remember, this is it's actually when you read the press release and you listen to the two calls the two companies held yesterday, it's actually a very narrowly defined structure. It's just software. There's some Rivian headcount. There's some cash to pay them. So I think they're intentionally keeping it very narrow. And they both said it very clearly. We're operating totally independently. We're competing head on with each other. Remember, VW has that Scout brand that they're going to launch in the U.S. that competes with the Rivian. So I think it may be okay because it's such a narrowly focused endeavor. Just software, for the specific purpose. It's not like the two are merging or Volkswagen's buying Rivian or something like that. If that was happening, then you'd have the culture dynamic. So yeah, I think it could work because it's so narrowly defined.
I want to end by asking you, does either company here stand to be better fit as a competitor to Tesla off the heels of this deal?
I don't know if I would look at it in that context. I think what this basically does is it gives a cash infusion to Rivian so it can fight another day. For Volkswagen, they've had software challenges, and it basically gets them there quicker instead of having to do it in-house with the challenged internal software arm that they have. I think that's all this is. Just two OEMs who have their own issues, and there's a complementary dynamic here with a very narrowly focused JV structure.
All right, Tom Narayan, always great to get your insight. Thanks so much for hopping on with us this morning. RBC's Global Autos Analyst. Thanks, Tom. We'll keep it right here on Yahoo Finance. We got much more of your market action ahead. Again, we're just about 45 minutes into the trading day. You're looking at a mixed picture. You've got the Dow and the S&P trading just below the flat line. You've got the Nasdaq, though, holding on to gains up just about 0.3%. We'll be right back. You're watching Catalyst.
Let's take a look at some trending tickers that we're watching this Wednesday morning. Taking a look at shares of Micron, up about 0.7% ahead of the company's earnings report. That is expected to come after the close today. Expectations for the company are high, with investors looking for proof that the AI hype is paying off for the company. Now, this comes after shares of Micron are already up about 65% this year. Just to put those expectations into context, the stock has been gaining ahead of this report. And just to run run through some expectations from the street. $6.7 billion in revenues expected for this quarter. That's going to be an 80% jump from a year ago, and that is going to be driven primarily by pricing power. We've been seeing a recovery in the demand for PCs, for smartphones, and the cyclical nature of that is getting a little bit more attention from Wall Street because it's a little bit easier to anticipate than what we might be able to expect from the AI rally. Shauna, we know the PC and smartphone demand structure a little bit more clearly. So seeing a return to that kind of cyclical demand is a positive catalyst for this stock.
Yeah, I think the main focus here for investors is going to be if we see any shift in terms of that demand when it comes to the supply side of things, whether or not they're able to meet that demand and what exactly that demand more specific looks like, and then what we can suss out from that in terms of what that then tells us about the overall health and strength here of the chip sector. Because like we were just talking to Stuart Kaiser about earlier in the show, and he's been following it as well as many strategists out there in the street, just more broad-based, the outperformance that we had seen of many of these names and interest of many of these investors in the chip makers almost across the board here over the last several months. And that has started to shift just a bit. But I think when you take a look at a name like Micron, the outperformance of this stock relative obviously to the S&P, but even relative to its peers within the space, it's up 70% so far this year. So when you take that into account, with it is largely viewed as a big beneficiary, obviously, of the AI trade, of AI adoption, and exactly the role it is going to play in that story going forward. And we've seen that name swept up with many others that are on the screen right now when you're taking a look at Nvidia and at Broadcom. So again, what exactly this signals about the overall health of the industry and demand-wise, I think is really going to be the focus there of Micron after the belt today. All right, let's talk about Apple. It's getting an upgrade this morning. Rosenblatt analyst Barton Crockett is saying that now is the time to buy the stock, specifically citing the company's privacy-focused AI work. Now, Crockett increasing his price target by $64 to $260 a share, upgrading the stock to a buy from neutral when it comes to some of those reasons, saying that strong privacy is by far the top feature consumers want in AI. He said that as a result of a survey of U.S. consumers done by Rosenblatt. So again, seeing more room for the stock to run with that strong price target here on the stock, implying just over a 20% gain from right around where it's trading today.
Yeah, it's interesting. And this is something that we spoke about when there was that initial news of Apple and OpenAI going into a partnership potentially moving forward. And this idea that consumers were going to have to opt into every individual AI interaction on their smartphones. That is really similar to kind of the ethos that we've seen at Apple with regards to privacy throughout its tenure here as the main iPhone maker when it comes to consumer sales in the US, at least. I also think it's interesting in this note, they talk about Apple's chips specifically, saying Apple silicone appears to immunize Apple from cost pressures at hyperscalers, talking about the other hyperscalers that maybe haven't been able to get ahead of the R&D required for making their own silicone for their own chips. Apple has been a leader in the space when it comes to their chip making, and that is potentially creating a little bit of a moat to protect them from that pricing power that we just talked about from a company like a Micron, which can kind of raise prices at the expense of these hyperscalers moving forward. Now, another stock that we are watching here, Robinhood, could rally another 31%. That's according to Wolfe Research. Analyst Steven Chubak upgraded the company to outperform from peer perform. The analyst noting that Robinhood has strong fundamentals and will be able to build on what has already been a strong year for Robinhood. And also, we should mention that this stock is already up in the trade this morning as well. And this, though, still would imply a 31% upside for the stock moving forward. And interesting that he's pointing out the fundamentals underpinning the stock as opposed to something that is a little bit less clear, given that Robinhood has seen a positive catalyst from the less clear trades, the meme stocks, the roaring kitty of it all. That has been a beneficiary. Robinhood's been a beneficiary of that. But this analyst notes that the fundamentals here are part of what's going to drive the stock.
Yeah, he went on to note that some of the recent price swings, especially the spikes that we have seen in Robinhood related to the meme stock rally, a lot of that he characterized as just noise and really having no bearing on the company's positive view here of a Robinhood. So a couple of reasons as to why why they are bullish on this name. A lot of it coming after a recent meeting or conversation the analysts had here with Robinhood's chief financial officer, saying that conversation left him with more conviction in the durability here of Robinhood's earnings growth algorithm. He goes on to say that he expects Robinhood could double GAAP EPS over the next 2 years, the strongest growth algorithm in our rate-sensitive coverage. He also went on to say that he continues to compound at a 30% annual rate beyond 2026. So again, setting a price target of $29 a share, about $7 higher from where we are trading today. And again, very positive of some of the underlying fundamentals and momentum that we've seen in the name, and very much independent of some of that excitement that we've seen that has been driven by that meme stock rally here over the last several weeks.
Absolutely. Well, coming up, we're going to speak with an analyst calling Uber a, quote, sleeping giant. We'll dig into the details behind that call after the break.
Uber getting a bullish call from Piper Sandler, the firm reiterating its overweight rating on the stock, raising its price target from $86 a share to $88, saying that Uber's scale makes it a, quote, sleeping giant. Let's talk about it. The analyst behind this call, Tom Champion, joining us now. Tom, it's great to talk to you. So I guess break down this view of why you see Uber as a sleeping giant relative to many of its peers within the space.
Hey, good morning. Thanks for having me on. Yeah, we dug into the topic because earlier this month, Lyft talked about its longer-term ad revenue and bookings targets, and we received a lot of questions from clients on, the likelihood that Lyft would be able to achieve those. And so we wanted to dig into the topic holistically for the gig economy group overall. So that this would be the bucket that includes Uber, DoorDash, Lyft, and Instacart. And through that analysis, we came away impressed with Instacart's existing opportunity in advertising. They have a very well developed ads business at this point with a very high attach rate on bookings. But the sheer scale of Uber was quite compelling and led us to think that, really in the context of this advertising opportunity, Uber's the name to watch.
Okay, so Tom, I just want to take a big step back and walk our viewers through exactly what we're talking about here. So when you talk about Uber having opportunities, I know they just opened up Journey ads, for example. You're talking about advertisers being able to target Uber riders through the Uber app after bookings. Is that correct?
Yeah, that's correct. Or via the Uber Eats platform as well, or increasingly in the future on the grocery side. That's an emergent area of their business as well. But I think the way to frame this is we've seen over the last 6 or 8 years, Amazon build this gigantic advertising juggernaut, and a lot of this is done through sponsored listings, the ability of Amazon merchants to advertise and promote their goods. And we believe that in all transaction platforms, there exists this promotional advertising opportunity. In the gig economy space, Instacart is the one that has developed this part of the business most to this point. But with Uber's scale, which really kind of dwarfs the rest of the space, the future looks very interesting.
So Tom, when you take into account, I guess, how much of a jump or how much growth we could see in the ad revenue, what that opportunity looks like for a name like Uber versus a name like Instacart, leaders within the space versus some of the other smaller players when it comes to the gig economy. I guess putting that in context for our viewers, how confident you are that Uber is going to be able to capitalize on this opportunity, and then more specifically, how big of a driver catalyst you see this being for Uber stock?
Sure. So what I would say is that I believe management in their comments are over time revealing the playbook here and what they are attempting to build. And with many of these transaction business models or gig economy business models, unit profitability is sometimes challenged. These are not overly profitable consumer internet models. But advertising is a great model. And so over time, to the extent that these businesses can evolve or develop their advertising business, I believe that this can prove quite accretive to margins. And there again, I would just highlight that we believe there's a $5 billion advertising revenue opportunity for Uber by 2027. And if they're able to hit that, I think there's going to be upside to consensus EBITDA expectations, which are about $13 billion today.
All right, we're going to have to leave it there, Tom. Thank you so much for joining us on this call. We really appreciate it. That was Tom Champion.
Thanks for having me.
He's Piper Sandler's senior research analyst. Tesla has got some new competition in the autonomous vehicle space. New robotaxi service called Vern, created by the Croatian automaker Rimac, will be launching in the country in 2026. That's according to an announcement from the company today. Yahoo Finance's Pras Subramanian is here with the details. Pras, thanks so much for joining us on this. So another new robotaxi service. What do we know?
Well, it's called Vern, right? Kind of after the author Jules Verne, who sort of invented the future, right? That's sort of their North Star there. But yeah, I mean, it's a very compelling looking vehicle, and it's part of an ecosystem, right? So this vehicle looks almost like a VW Golf on kind of steroids, like really great aero treatments. But then the inside is actually near luxury, premium level interior, no pedals, no steering wheel. It's going to be level 4 autonomous robotaxi. You're going to be operating in Zagreb, the capital of Croatia, I believe, in 2026. But I think the big picture is they've come out with this vehicle a few months ahead of Elon Musk's robotaxi reveal, right? Is Musk's robotaxi going to look this good and have this kind of level of luxury kind of appointments and also work with this as an ecosystem, right? This comes with an app and has like a mothership, they call it, to service the cars. Like, what's the Tesla offering going to be like? And we're kind of seeing what other competitors are doing.
Yeah, I was going to say, I'm curious from your perspective, I mean, the analysts that you've been talking to, like a company like this, their ability, are they really a threat to Tesla, do you think, in the longer term? Or is this something that Tesla could actually use to its advantage and say, hey, here are maybe the XYZ issues that this company has since they are first to the road, and here's why our robotaxi then ultimately makes more sense for the longer term?
So Rimac is obviously smaller than Tesla, but it's no slouch. Its technology is being used by BMW. It owns Bugatti now. It's Bugatti Rimac is the joint venture. So they do a lot there in the automotive space. The guy, Mate Rimac, is the founder. He's around 30 years old. He's known as Musk without the baggage, right? He's a brilliant guy, an entrepreneur, but doesn't have some of the other things that kind of make Musk somewhat problematic. So there is some comparison there. Now we're nowhere near as big as a company. Obviously Tesla kind of has that industrial know-how and base to kind of make things happen. But I think they can look at this and say, oh, what do we have to do here to kind of, are we ahead of them? Do we have to meet some sort of criteria that they already have? I think it's a good way to kind of show where the two sides are at right now, or whoever else is in the space.
Really good point, Praz. Thanks so much.
And I think the vehicle looks beautiful.
Nice.
And the thing is, are we going to see the robo-taxi from Tesla look like a mini Cybertruck? That's the issue. If you see that car like a wedge-shaped, stainless steel thing, are you going to hop in that or this? I mean, that's kind of the big question.
This would be my answer.
Yeah. I mean, this company does say that they do want to deploy this worldwide. So there is worldwide ambitions for it.
It is interesting, though. I've seen one robotaxi in Manhattan. Have you seen more than that here?
No,
Yeah,
I mean, not yet. No.
It really sticks out. You know what I mean? You're like, that's different than all the other things.
Right.
Right. One could call it an eyesore. I'm not saying that. Praz, thanks so much for joining us. Really appreciate it. Coming up here, after a big month for tech stocks in May, one ETF fund made the decision to reduce exposure to tech in the month of June. We'll dive into why after the break. volatile week for Nvidia here, but that has not derailed the overall market rally too much. Kraft's AI-enhanced U.S. large-cap ETF, that's under ticker symbol QRFT, has decreased its allocation in Nvidia from over 6% in the month of May, now down to just 0.7% in June. Joining us now to discuss this, we've got Weldon Rice. He is Kraft Technologies head of AI ETFs. Weldon, great to speak with you. Thanks for coming on the show. I mean, let's start with exactly that, right? Decreasing your Nvidia allocations by that much is a curious move given the overall market rally that we've seen. I mean, a third of the S&P's rally has been attributed to just Nvidia alone. What's the justification?
Sure. Thank you for having me on. And yeah, just to, for the viewers out there that may not know who we are an AI investment technology company. And for QRFT and all three of our ETFs that we have, we use artificial intelligence to actually select the stocks in the portfolio. And so, yeah, this last rebalance that we had, we changed the holdings every month. And Nvidia, suddenly dropped out from the, it was one of the top holdings in the previous month, dropped down from 6% all the way down to, just below 1% in the portfolio. And, what we've seen over the years with our ETFs, which are now over 5 years old, is that they tend to, sometimes want to take profits in some of these stocks. And, Nvidia is one that has, had an unbelievable year to date and had a great May. So, we feel that the AI model was thinking that is a great time to take profits. Despite, not having Nvidia in the top holding, it's put up about 5.3% this month in terms of performance, which is outperforming the S&P. So you can dock it down as one of the few funds probably out there outperforming the S&P with, without Nvidia. So I think that's quite interesting.
So I'm curious because you said that it's an AI-driven ETF. So you're strictly relying on AI technology to make these types of decisions. I guess how much is there this human element of human involvement? And is there any rationale, I guess, behind some of the moves that have been made here over the last several weeks with your funds?
Absolutely. So in terms of how we construct our portfolios, you're absolutely right. We use artificial intelligence purely. So now, obviously, humans are at the construction of the model. So we're we have experts here in-house that are helping to drive what data points are made and what types of models are being used and those sorts of things as we research more and more. But once the model is made and trained, it just takes in new data every month, and then based on its training, it makes its decisions, and we don't change those. So when it came through that Nvidia had dropped down that much, there was no human that said, oh no, that's the wrong way to go.
Yeah.
We need to change that. In terms of the rationale behind it, that actually is one of the bigger challenges of artificial intelligence, is that it is somewhat of a black box because we are using these deep learning models that are looking at very complex relationships, relationships of data. And so it becomes a little bit difficult to, understand that. But one kind of breakthrough we've seen recently, not exactly in QRFT yet, but the recent fund that we launched in November with LGI Research, that fund has an element of using large language models, which is basically like ChatGPT. And so now we've been able to, LGI Research has actually been able to produce a report looking at why the AI model picked the stocks that it did. So it's actually quite interesting. We're actually just now starting to put that up on our website for investors to go look at, and we think this is really really the next step in AI innovation for investment decisions with AI.
What's the math that the AI is using that investors are not using to suss out Nvidia?
So I think that the way that artificial intelligence looks at the market is very different from a human. One, we're just looking at it purely from the data perspective, but the way that we're able to look at, generally in the past, when we look at either fundamental managers or when we look at traditional quant managers, the models typically are quite linear. And so what we're able to do with artificial intelligence is as again, we're looking at the relationships to data, but we're looking at the relationships to the data, and we get this kind of non-linear look at the market that a human is not able to see. And I think that's what makes this so unique. And I think this is what is really promising for investors, is that you're getting a very different look at the market in your portfolio than you would from a traditional human active manager out there.
All right, Weldon Rice, Kraft Technologies, head of AI ETFs. Very interesting. Thanks so much for joining us.
Yeah, appreciate it. Thank you.
Let's turn now to the streaming space. YouTube dominating its competitors, making up almost 10% of all viewership on connected and traditional TVs in the U.S. in May. That's according to the latest numbers out from Nielsen. Yahoo Finance's Alexandra Canal joining us now with the latest on that. And Ali, it's pretty impressive. Almost 10% there of overall viewership, all driven by YouTube, it looks like.
Yeah, so YouTube not only taking over your computer screens, but also your living room television screens as well. And I want to reiterate that stat. 9.7% of overall viewership on connected and traditional TVs in the U.S. for the month of May. Now, this is the largest share of TV for a streaming platform ever reported by Nielsen. And the difference between first and second place illustrates just the overall dominance of YouTube as well, since Netflix came in second with 7.6% of overall viewership. And then if you look at the pie just among streamers, YouTube's total viewership was close to 25% of overall market share. And media companies are certainly starting to take notice here. Even with my conversations among different executives, analysts, YouTube is consistently brought up as a top competitor. And then if you think of the success of user-generated content and how YouTube has really been able to leverage that, you wonder if some of those competitors will perhaps dip their toe into user-generated content of their own. And remember that earlier this year, the company did announce that users watched more than 1 billion hours of YouTube content on TV screens every single day. So a lot of potential there. YouTube creators are now in a position where they want to start being considered for Emmy Awards. They want to start positioning themselves as real producers, directors that can stand side by side with the rest of them in Hollywood. So YouTube has been around for a while, but now it seems like it's finally starting to have its moment in the sun, and a lot of these media companies are going to be forced to look at them as a real competitor.
I want to zoom out a little bit here because I know you've been following some of the conversation around streamers potentially offering free access to their platforms while also kind of having an ad-supported tier that can pay for that. Is that even... I'm so fascinated in this because why would Netflix do something like that when I'm already used to paying? Why would they offer a free? It's obviously to gain market share. I'll let you answer the question. I'm just I'm so confused by the thinking.
So the thing is, there's a lot of different types of platforms out there, right? Yeah. You have your subscription-based platforms that you can get from a Netflix or a Disney Plus, but there's also free ad-supported platforms. They are called FAST channels, and that's your Roku TV, Tubi, which is owned by Fox, Pluto TV, which is owned by Paramount. And I thought the same thing. Why would you choose to want to watch ads? Why is this an attractive offering for consumers? But Nielsen data shows that all of those FAST platforms are actually having pretty significant growth. Tubi, for example, saw 46% year-over-year increase when it comes to overall viewership. Its average audience is now ahead of some of those traditional streamers like a Netflix or a Disney Plus. And then Roku captured a platform best 1.5% share of overall TV and was the only platform to actually climb the ranks for the month of May. So it points to this desire for free content as all of these streaming platforms are raising their prices. And it also shows the optionality that consumers have. If you are choosing an ad-supported tier, if you are choosing to watch ads because it is free, you're more willing to watch those ads, you're more engaged, that's attractive to ad buyers. So experts that I've spoken with have said that's largely the driver here. Also, going back to YouTube, that's really the first free ad-supported service that we had. And if you think about it that way, a lot of these younger consumers are now more used to ads. They're more used to having content at the click of a button, and they don't have to pay those subscription fees. So it's an interesting time that we're seeing amongst all of these streaming platforms. And what does this mean in the future? The experts that I spoke with said that it means more bundles, and that potentially we could see a world where you could create your own bundle, have a FAST channel, have a subscription-based channel, and then hopefully
wobbly that provides all the content that you want. So it's just a time of disruption right now. But to me, this stood out, especially as these Nielsen numbers trickled in for the month of May.
So interesting. I find myself accidentally stumbling upon the free offerings on my TV.
It's
somehow.
there. It's right there. You can watch it.
Yeah.
And a lot of them are aggregators of really top pieces of content. I think you can watch Top Gun on Pluto TV. So why would you not do that? And then you have Roku dabbling in original content. So, they're, for the consumer, it's great. You have a lot of different choices.
Yeah, and I also wonder how much of this is also just a sign of the more macro environment that we're in right now, right?
Totally.
Just in terms of people being pressed for cash, many people having to make those tough decisions, and maybe that is contributing to some of that outsized growth that you were just mentioning of these free offerings versus those that
Paramount announced they were raising prices on Monday, coming August. So it just keeps happening. It adds up at the end of the day.
It's a really good point, Allie. Thank you so much for joining us and bringing that reporting to us. Really appreciate it. That was our very own Alexandra Canal. Now we're going to have all of your markets action ahead, as well as what we think you should be watching for the rest of your trading day. So stay tuned for that. You're watching Catalysts.
We're about 90 minutes into the trading day. Here are three things that you need to pay attention to, three potential catalysts for today's trading day. First up, we've got Micron earnings that are out after the bell. We've also got Nvidia's shareholder meeting and the Fed's bank stress test. Those results are actually going to be out after the bell here, Maddie. So a couple of things to break down here. Let's kick it off with Micron. We talk a lot about the chip space and exactly what these earnings results are going to tell us. It's going to give us an inside glimpse at what exactly demand looks like. And then, of course, investors can suss out what ultimately that means in terms of the catalyst driving prices higher potentially here if there's solid results for the broader chip sector.
Yeah, this is a stock that's up over 60% this year. So they're going to have to prove that they've got a strong differentiating and competitive factor for this name that's specific to them and not just specific to the broader AI rally, and whether or not the cyclical return of demand for things like PCs and smartphones are going to be enough for them moving forward. Similar news in the chip space that could be a big catalyst to watch for the rest of your trading day. We've got the Nvidia shareholder meeting coming up today, and Jensen Huang is going to be expected to be speaking. Could that be a catalyst for this stock that's been, as we mentioned, bopping around throughout the morning? It was up, then it was down, then it went back to the upside here. It looks like Nvidia's shares still moving here, down over the past 5 days, but obviously still up over 160% year to date. Could we get some news out of the shareholder meeting today that could potentially be meaningful for this stock? And then, Shauna, as you mentioned, we've got the Fed's stress stress test for some of the big banks. That's another big catalyst for the trading day here.
Yeah, that could be a big catalyst. We'll have to see what the results are here from the Fed. That is going to be released after the bell here today. Just around a year ago, I believe 3 banks did fail those stress tests. So ultimately, what exactly this means, this is really an indicator just in terms of how much cash these banks have to hold to withstand a downturn here in the broader economy. It's also going to determine how much they can return to shareholders via dividends and also via share buybacks. So that, of course, could ultimately be a driver here for this sector, for many of these names within the banking sector here over the next several quarters. So again, a couple of, obviously you have the bigger names on your watch list as well as some of those smaller tier 2 names too that could move on the heels of these results.
Absolutely, Shauna. All right, well, keep it right here because coming up, we've got wealth dedicated to all of your personal finance needs. Our very own Brad Smith is going to have you for the next hour, so stay tuned for more.
Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts is going to give you the resources, tools, tips, and tricks that you need to grow your money. Hey, on today's show, the new home market is hitting a 6-month low as high mortgage rates weigh on buyers. We'll talk to an economist about when you can expect mortgage rates to fall. Plus, Chipotle's 50-for-1 stock split just went into effect. We'll talk about what it means for you, the investor, and whether or not now is the time to consider adding on a little bit of some exposure to the burrito maker. Plus, having the money talk, discussing finances can be a tricky subject. Our personal finance reporter, Carrie Hannon, is going to give you the tips and tricks you need to talk about money with your own family. All that and much more coming up during today's show. But our top story this morning, more troubles in the housing market here. New home sales in May plunging 11% from the prior month to 619,000. Analysts on Wall Street expected 633,000, so that's a big miss there. The drop in sales activity also leading to an uptick in available inventory, which means more homes are sitting on the market. All of this largely an impact of high mortgage rates, which continue to weigh on home buyers. Here with more reaction, we've got KPMG economist Yelena Malayev. Yelena, great to have you here. I want to just get your broad read here on what we're seeing in the housing market, considering some of the moves that we're now tracking both week over week on the mortgage rate side and then month over month on the sales side as well.
Definitely. Thank you. The housing market is definitely in a fragile state right now. This higher for longer interest rate environment is weighing on potential buyers. Those who own a home and are thinking of selling, they're locked in with a significantly lower mortgage rate than is available currently in the market. And then, of course, builders are facing a lot of hurdles with, still tight labor market for the construction industry, the need for land, materials. And then, of course, they're also facing financing costs that are going up due to the higher interest rate environment. Around the end of last year, the market was expecting for interest rates to be lower by now. And of course, that hasn't happened yet. So this kind of longer time frame of high interest rates is really starting to take a toll on the housing market.
When do you expect the housing affordability squeeze to perhaps abate a little bit?
It's a great question because we were expecting interest rates to be lower by the second half of this year. Now we've pushed that forecast out into December. So we do expect one rate cut in December, which will help bring overall mortgage rates to perhaps around 6.5 by the end of the year. That's probably not what people who are waiting for those 3% mortgage rates are wanting to hear, but unfortunately those days are behind us, barring any sort of crisis or anything that would require rates to go back down that low. By the end of next year, we could have a few more rate cuts in the pipeline, maybe bringing mortgage rates to 5.5. But the other side of the affordability puzzle is the housing costs, right? So the home values have still been rising very significantly because of that demographic tailwind from millennials aging into their prime home buying years, baby boomers wanting to age in place, and this significant lack of inventory, both in the newly built and resale market, meeting these demographic demands that is going to keep a floor under home prices for quite some time. But the mortgage question, we should have some reprieve into next year.
Certainly. And so one of the huge things that we're considering within the existing homes and new homes kind of combination to really round out the entire housing picture, not the entire housing picture, but at least a large line share of it, is really where on the new home sales side, we've continued to see new home build outs actually account for more percentage than some of the historical averages. What is your anticipation for how that will continue to moderate as we move on throughout this mortgage rate environment?
Definitely. And this period of higher interest rates, especially when we first started to see them pick up quickly in 2022, should traditionally have made builders pull back on building. But instead, due to the demographic tailwinds, they've ramped up building, of course, with significant hurdles. They can't ramp up that quickly to meet demand, but they've been really benefiting from the tight supply in the resale market by being able to build homes, offer mortgage rate buy down. So instead of the 7% in the market, they might offer something like 6 or even 5.5. And they've also scaled down. They've been able to change their buildings so that they're building smaller homes, something more fit for a first-time home buyer. Now, that's not the case across the entire country, but definitely in some pockets of the country where it's easier to build. And then, of course, continued tightness in the resale market is just going to help keep that balance of more newly built homes on the market to be on that higher end rather than traditional timeframes. But of course, as mortgage rates come down, more sellers will start to re-enter the market. We have seen a pickup in inventory. It's still quite low in the resale market, but it is picking up. So if mortgage rates come down, people feel less constricted by that lock-in effect. We will have more of that balance where newly built homes could be more of that share of the market, let's say 20% rather than the 35 or so we've seen lately.
KPMG economist Yelena Maliev, thank you so much for taking the time here today and breaking this all down for us on the housing front. Appreciate it.
Thank you.
Certainly. Well, stocks are mixed. About 90 minutes into the trading day, the Dow and the S&P 500 both trading a little bit lower here. The Nasdaq holding on to gains, though, right now, but off of today's session highs. Stocks have been doing well all in this year, in large part due to strength in Nvidia. Over 38% of the S&P 500's gains so far are due to semiconductors, also known as the chips that power artificial intelligence and a bunch of other things. So, is there more room to run for the AI trade this year? To discuss how you can set yourself up for success in the second half of the year, we've got a good friend of the show, Jay Jacobs, BlackRock, U.S. head of thematic and active ETFs, here as part of the ETF report brought to you by Invesco QQQ. Jay, great to see you here today.
Great to be back, Brad.
Absolutely. So let's dive into this. I mean, when you have so much of the market's gains thus far concentrated in one core theme, what does that mean for potential broadening, and what ETFs could investors consider adding to their portfolio if that broadening does start to take even more shape?
Well, I think investors have to look at the big picture with artificial intelligence and really try to understand what's the next shoe to drop. What's the next part of the market that could see similar run-ups that we've already seen thus far in some segments of AI? What we're focused on is really what are the picks and shovels in artificial intelligence. So we believe there's going to be more adoption of AI, full stop. It's a huge technology, it's transformational. We believe that about 5% enterprise adoption that we see today is going to move to 80% adoption in the next few years. But what are the companies that, no matter whether you go with Claude, whether you go with ChatGPT, no matter what AI platform you go with, are going to benefit from this build out? And what we see is about $1 trillion that has to be spent on AI infrastructure. That is digital infrastructure, that's like data centers and cell towers, which you capture in our IDGT ETF. That's semiconductor companies, and not just GPU manufacturers, but a broader ecosystem of semiconductors that we capture with our SOX ETF. So it's really focused on that next layer, the picks and shovels that will benefit from the build out of this core technology.
And so where does that point investors' attention towards? Is it things like everything that has to power the data centers, for instance? You think about utilities. You think about the need for even more cybersecurity as well around some of these data centers too.
Absolutely. I think energy is a really important aspect here because you're going to see a massive incremental demand for energy, not just from artificial intelligence, but you think about the growth of electric vehicles. You think about renaissance in U.S. manufacturing that we're seeing recently as well as driving energy demand. So our electrical grid and power generation just isn't really designed to see 2%, 3% compound annual growth.
Meanwhile, I'm getting texts to turn down my thermostat or my AC and knowing all these data centers are going to be built up tapping the grid too.
So that's the point, right, is that we don't have capacity yet to build more electric generation. So this is going to impact the whole energy infrastructure. This is going to mean more generation. This is going to mean upgrading power lines. One of the key components that I think the market doesn't quite recognize yet is copper. Whether you are building renewables, whether you are building transmission lines, whether you're building data centers, all roads lead through copper, and it's already a metal that's in structural undersupply. So this could be a choke point within the physical build out of AI and energy.
Is there a commodity or copper kind of ETF play that investors you've seen some volume kind of clearly flowing into?
Yeah, well, we've seen an uptick in our copper miner ETF, ICOP, and it's specifically for that reason. These are the companies that are taking copper out of the ground and making it usable in things like power transmission.
All right, some of the original mining and then ultimately putting that to use here. Thank you so much, Jay. Jay Jacobs, BlackRock, U.S. head of thematic and active ETFs. Great to see you. I don't know if you get those texts too about turning down your thermostat.
Oh, absolutely.
It hits me a little bit harder sometimes. I'm just like, come on, text the companies across the street from me, commercial real estate.
This is a tough week for that.
It is, yeah. Jay, great to see you, man.
Good to see you.
Absolutely. Have you had the talk yet? You know, the one where you have to talk to your loved ones about handling their wealth when they pass. Well, nearly half of Americans plan to leave an inheritance, but less than a quarter feel prepared to pass on that wealth, according to Edward Jones. To break down how you can have the talk, we've got Yahoo Finance's very own Carrie Hannon here with us. Hey, Carrie.
Hey,
all right,
Brad.
the dreaded talk. What's the, I mean, do you slide, a cup of coffee across the table, or, I don't know, maybe a hard liquor in this case?
Well, money is such a taboo subject, and parents are incredibly private about how much they have. And in many ways, they don't want their kids to know because they don't want to, quell their ambition or, in any way get them their own desires to think they're inheriting. They'll slow them down with their own passions. And also they wonder, how much am I going to need? How much longer am I going to live? They want to be careful about that equation. So here's a good way to get started. I mean, there's some certain inflection points that you can start that conversation with your parents if you don't already have an open money environment. And the one I like is the first one is downsizing. If your parents are downsizing to a smaller home or moving to an assisted care, natural moment to bring up some of these topics. And you start with sort of little things like, oh, you know, that grandfather clock you have, or that beautiful silver bowl. Hey, Mom, hey, Dad, can you tell me a little bit about that? What does it mean to you? What's the family story? And express that you're interested in that. That would be something that you really would value also. These are just little things to open the door. The second thing would be if there's a family holiday and you're all getting together in this nice little environment, and you start things like, you know, compliment your parents. Say, this is the first, you know, the most important money lesson you taught me when I was a kid. Or this was my first memory of money, thanks to you. And what was yours, Mom and Dad? So open up that, you know, that sort of icebreaker. Let's talk about money here. So you start moving that direction. The third thing is if you're doing your own financial plan, this is fabulous. You're doing your own, you're working with your wealth advisor, you're excited. You wanted to tell your parents about it. Hey, look, I'm doing this, and I'm asking questions about what will I regret if I didn't do this with my time and my money and so forth during my lifetime. And I say to them, have you done that? How did you plan for your stage of this life, this chapter of your life? How did you go about it? And you slowly draw in, and your advisor's talking to you about leaving, you know, paying for higher education for your kids. Hey, would that be something that they might be interested in helping out with? So you start doing it that way. Get them, pull them into your own planning and say, yeah, now I'm stretching out down the road, and you think about what assets I might have in the future. Be subtle, but be direct on a certain level that this is coming down the pike. The final thing people can do, and many investment houses offer this, I think Fidelity does, Vanguard might, that you have a formal family conversation where you have somebody impartial sit down with your family and let's have this discussion in an environment that's safe. Bring all the kids in, Mom and Dad, and you know, you start by pulling maybe a jar, you pull something like words out of, like legacy or money.
The roulette.
What does that mean to you? And you get touchy-feely, but it's nice. And parents might really be surprised to find out things like their kids don't all want to inherit equally. Like they feel like one sibling needs more than another. This is kind of cool stuff. Or parents may say, you know what, I really want to see the rewards of what I can give while I'm still alive. So it gets the wheels turning in all these sort of situations. But the important thing is get it started. Don't be afraid to start it because it's very important in your own future wealth.
Those are all great icebreakers. So once you get the conversation out of the way, how do you manage inherited wealth?
Yeah, you know, Brad, the important thing is to not be sort of frozen by this idea, to really, you know, bring your own financial advisor in on this to help you. No rash moves. This is something that needs to be, especially if there's tax planning involved in this. This is a process. So if you can get your parents on board with you, then work with your own advisor and perhaps even theirs to sort of make a plan. This is a blueprint. So be cautious, you know, take your time and just, you know, enjoy the process. Don't get so worried about it.
Trust the process. Us Philadelphians have heard that for many years. Carrie, we're spreading the good word more broadly here. Appreciate it.
Thanks, Brad.
Thank you. Coming up on wealth, storing your money. Yahoo Finance's very own personal finance reporter will reveal how much money you should be keeping in your checking account. And this week's tech support. We'll talk about internet search browsers and whether or not Google should still be your number one. Ooh, that's gonna step on some toes. Plus, Chipotle's 50-for-1 stock split. Yahoo Finance took to the streets of New York City to ask if people would invest in the burrito joint. We'll reveal their answers right after this break.
My go-to Chipotle order, it is a brown rice burrito bowl to go with black beans. I add guac and some medium salsa and romaine lettuce. No cheese, no sour cream.
It's always a burrito bowl. Tend to skip the guac, don't like to pay for extra guac.
Rice, beans, a little bit of meat.
Like a bowl, but they don't have nachos option. I basically kind of make it into nachos.
I like the tacos.
White rice, beef, get the lettuce, tomatoes, sour cream, finish off, shake it up.
Some unhinged orders you just heard from a number of folks out on the streets of New York City. They all sounded pretty good, and they were all talking Chipotle. Yahoo Finance's Brooke De Palma went out there yesterday to talk to people about Chipotle's 50-for-1 stock split. Just went into effect at the market open today, we should note. Brooke, tell us a little bit about the stock split and what you asked these patrons of Chipotle, clearly.
These patrons, these customers, these very loyal customers, as you noted, burrito chain Chipotle conducted a stock split. Now, that means if you own shares as of market close on June 18th, you received, as you can see here, 49 additional shares for each one held. And when the market opened today, those shares, which were worth over $3,200 as of Tuesday's close, are now trading around $64 a share. Now, a reminder, a stock split does not affect a company's value. It simply creates more shares, reducing the cost of each individual share. Generally, stock splits are used to make shares more affordable for investors. And yesterday, as you saw, I went out into the streets of New York City to ask people what they thought of Chipotle and whether they'd consider investing. Now, we didn't run into any current shareholders, but I essentially asked people what they knew about stock splits and if they'd consider investing now that the price of each individual share has gone from upwards of $3,000 to just around $65. Here's what they had to say.
I think stock splits make it more available for retail traders to be able to afford it, but it just really depends on the health of the company.
But now since they're affordable, I might as well. So I definitely buy maybe a few and just hold on that and hope that it goes up again, and then I can, make something from it.
Ooh, I'll have to look more into it.
Is it going to go back up? That's the question, right? Like, you're diluting it, so you've got a whole load of new shares. That doesn't necessarily mean that the business is worth more. I'd probably wait till they have another E. coli scare, and then I'll buy in then again.
Why not? I mean, a lot of people are going there, so it might be a good deal. Definitely. I'm going to go buy some Chipotle stock. Open up the Robinhood app, let's go. Why not make more money, right?
Probably not, because I'm a boglehead, so I just prefer a very broad, diversified type of portfolio. So I don't typically go out and just buy individual stocks.
I think Chipotle is one of those companies, it's gone through a lot, and I think it comes back so much stronger every time it goes on a lull. It's worth it long term.
So most people said they'd consider it. Chipotle is one of the top trending tickers on Yahoo Finance today. Definitely want to make note of that. Lots of excitement around the stock split.
All right, waiting for hazardous events is not an investment strategy, but that guy also waiting for the E. coli is clearly, he's got some type of portfolio strategy. Anyway, some of the people in your video, they were wondering if the stock price was going to keep going up. How do stocks tend to perform after some of these stock splits historically?
Yeah, historically what we've seen is that stock splits are typically bullish for companies, and when they do happen, they do see a good average return. And according to Bank of America, average returns 1 year later following stock splits are about 25%. Now that's compared to an average return of roughly 12% for the broader market. I do want to point out one stock that I followed closely as well, Walmart. They conducted a stock split back in February, and what we've seen in the last 3 months is that stock rise roughly 12%. And so there is lots of excitement following a stock split. And as we noted earlier, it also does allow more investors to jump in at a lower price.
Absolutely. Brooke, all right, out there in these streets.
Getting it all. Getting all the takes from all the New York City folks.
Indeed. And some investors out there. Yahoo Finance's own Brooke De Palma. Brooke, thanks so much. Let's stay in the food theme here. Another big food company in focus today, it's General Mills. Investors seeing shares of the cereal maker fall today as its latest quarterly results reveal just how much consumers are pulling back on spending. High grocery prices have remained a sticking point for consumers, even as inflation data shows that prices are easing. Now, consumer confidence, it ticked lower in June as Americans said that elevated prices, particularly food and grocery prices, weighed on their views of the economy. And this is weighing on companies like General Mills. The maker of Cheerios saw lower volumes in its latest quarter, which means that grocery stores are ordering less inventory because consumers aren't buying as much. General Mills' overall volumes fell 2% year over year in its latest quarter, with volumes in its biggest unit, North American retail, down 6%. Overall, net sales were down 6%, and still, General Mills remains optimistic that consumers will indulge in snack foods again soon, saying in the earnings release that it, quote, expects volume trends in its categories will gradually improve in fiscal 2025, end quote. Well, the median household's checking account balance is $2,800. That's according to the Federal Reserve Board. But how much money should you keep in your checking account? There's no hard and fast rule, but stowing away enough cash is crucial to be able to handle any surprise bills that life throws at you. To discuss this further, we've got our very own Molly Moorhead here in studio with us. So, Molly, $2,800 is what the Federal Reserve is seeing. What should the real number be that most people can set at least as an ideal target?
Well, as you can imagine, there's not really a number that applies to everyone. It's all in how much are your bills, your income, your spending habits. And so the good couple of rules to follow are you want enough that you'll never be overdrawn and enough that you have a cushion. And the cushion, if you can do it, is 2 months worth of your expenses. So if you have $4,000 in bills every month, if you can keep 8, that's good. If you can keep 6, that's good. But you just want to know that you're never getting too close to zero.
Absolutely. So once you have the right amount for you in that account, that 2 months of all-in expenses, what do you do with the extra?
Yeah, so the reason you don't want to keep it all in checking is that it's not making any money for you. So you want to put it in something that's going to be interest-bearing, a high-yield savings account. Those are paying like 5% right now, a CD, a money market account. Those are all good options that are liquid. And then we always want to be socking money away for retirement. So if you have a regular income every month, a salary, and you get that healthy amount in your checking account, then put it away for retirement. That's always a good play.
Absolutely. Molly Moorhead, thanks so much for breaking this down for us. Joining us here in studio, Yahoo Finance's own. On the other side of this short break, I'll speak to Alibaba.com's president on how business leaders are discussing and supporting small businesses with the right AI tools. Don't go anywhere. The World Trade Organization, the WTO, as you know them in your hood, kicked off its 40th Geneva Week on Tuesday. It's a twice annual week-long event where business leaders and executives travel to Geneva, Switzerland to weigh in on recent developments in international trade. Now, one point of interest this year is the potential of micro, small, and medium-sized enterprises, also known as MSMEs. Now, MSMEs, they currently account for 90% of businesses, more than 70% of employment, and 50% of GDP worldwide. And more experts believe that they are the backbone of many global economies. Joining me now, live from the conference for this Yahoo Finance exclusive, is Kuo Zhang, who is the president of Alibaba.com. Kuo, great to have you here, and thanks for stepping away for a hot second from the discussions taking place to hop on with Yahoo Finance. What are international business leaders pledging to do to protect small business growth from the conversations that you're having?
Sure. So hello from this is Kuo from Alibaba.com, and now I'm in Geneva, and actually in a kind of a discussion with WTOs, with ITCs about our kind of ongoing program to help to either help or incubate or empower SMEs. So our business, I talk a little bit about Alibaba.com, that we are founded in 1999 by Jack Ma. Actually, in day one, we are focusing on working or serving for the SMEs. I mean, SMEs for the both sides, both the sellers and the buyers. Actually, now we are serving more than 200,000 of suppliers all over the world, and we are serving more than, let's say, 50 million of the SMEs as buyers all over the world. So in a simple word is that we are using all the digital tools to transform the way they do business and help them to lower the barriers to kind of entry the global platform.
What do you believe that the health of small businesses is worldwide based on the interactions that you're seeing with Alibaba.com?
Right. So I can give you an example first. That when Alibaba founded in 1999, at that time, I see the numbers you said that the 50% of the GDP, kind of global trade GDP, contributed by SMEs. But at that time in China, actually, that number is less than 2% back in 1999. So now, actually, that the number in China is more than 62% of the kind of global trade GDP is contributed by the SMEs. You can see in the last 20 or 25 years, the SMEs actually have more and more power in the global stage, and now they are the backbones of the global business. And that the similar things happens all over the world, both in Europe, in US, the developing countries, as well as in developing countries like Southeast Asia, like Latin America, like Africa. So we are using our digital tools to empower them everywhere.
What is the ability for SMEs and micro and small and mid-sized enterprises to make the digital transformation like some large enterprises and multi-billion-dollar conglomerates are making as they're spending heavily on everything from blockchain to generative AI seemingly to make sure that they're staying ahead of the curve technologically?
Yeah, sure. So what we are doing actually, take AI example. So what we are doing is democratize AI. So we are heavily investing on the technology side, and we want to using the technology to empower the SMEs. So especially for this year, we are focusing on two things. One is AI. So using AI, we can improve the efficiency for both the buyers and sellers, and also transform our platform from a kind of a sourcing engine to a creativity engine. And the other is to kind of upgrade our supply chains, which is called Alibaba Guarantee. The meaning that when the buyer buy a product or source a product from Alibaba.com, we will take care of all the logistics, all the extra payment, financing services, as well as after-sale services. So that's greatly kind of lower the barrier and help the small SMEs to build the trust between each other. So this is basically what we are doing.
Quote, I wonder, especially considering the environment for elections this year, with more than half of the world going to be participating in elections of some sort or another, that could change what globalization looks like. That could impact companies like Alibaba.com as well. How are you positioning yourself to navigate what the outcome of some of these elections could be, knowing that it also impacts your core customers, both consumers or end consumers of products, but also other small businesses and mid-sized enterprises?
So from our perspective, actually, Alibaba.com is founded for more than 25 years. So there's a lot of elections, a lot of change during this kind of time period. And what the latest change or the challenge is the pandemic. Actually, after pandemic, we see that actually more and more SMEs now is a pirate time for them to change, to embrace the digital. And you're talking about the elections. Actually, what we are focusing on is the things that does not change. So take the SME is a buyer as example. If you are an entrepreneur and you want to build something, build your own brand and sell, there are a bunch of things that you need to focusing on. What a product I'm going to build, who are the customers, what are the targeting market, and how we can find a kind of best partner to manufacture it, and with the best price, quality, and what kind of employees I'm going to hire. And in the end, probably there's a tax, and the tariff is a part of the tax. So they need to consider a lot of things, but we are back to the fundamentals is demand and supplies, how to provide all the buyers with a variety of supplies, high quality with a competitive price and delivery time. And we just keep kind of doing on that and perfecting the tools and make sure that we can empower the SMEs and to make it easy to do business anywhere. So these are the things we think is not going to change for 100 years. And that is what we are focusing.
If there were more tariffs that were ratcheted up, would that have a net impact on your business?
So first of all, we are kind of a platform which supports global supplies. And the supplies not only from one country. Actually, now we have supplies from 200 different countries. And for example, in EU, in Europe, so there are kind of wines, there are fashions, there are machineries, and there are also a lot of other tools from Germany, from France, from Italy. And we have lots of suppliers from Southeast Asia as well. So that is number one. The second part is that, as I mentioned, the fundamental rule for global trade is demand and supplies. So always find the better supplies with better kind of price, and adding together is a kind of competitive strength for the supplier side. What we are doing is just lower the barrier and letting them easy to kind of go to the global to do business with each other. So that is basically what we are doing, and that is what we are focusing to do.
Kuo Zhang, Alibaba.com president. Kuo, thank you so much for taking the time here with us today. Really do appreciate it.
Thank you.
Certainly. Coming up, we break down how you can be an educated investor even if you're just starting out. That's right after the break. A rising number of Americans directly own stocks, about 21% of U.S. households owning equities, and that's up 6% from 2019, according to the Federal Reserve study of consumer finances. And to discuss best practices for do-it-yourself investors, Andrea Finnan, who is the JP Morgan Wealth Management Head of Self-Directed Investing, is here. Thanks so much for taking the time here with us today.
Yeah, thanks for having me.
Okay, so where is kind of starting point number one for the DIYers of their own portfolio who are saying, I want to be a little bit more active in my own strategy?
Sure. I think it's important for our DIYers to understand where they're at in their financial life, right? How much do they have to invest and what's right for them, right? So getting started early is a really important tip, but I think acknowledging where the industry has evolved, right? Interest rates have risen over the past few years, and so people who were investing in both equities and some options activity really need to think about the full continuum of asset classes, right? All the way from cash and FDIC insurance, all the way through to fixed income bonds, treasuries, money market funds, ETFs, and mutual funds. And I think now we're landing at a place where people really need to think about where value is in equities and really build a portfolio around that.
So say after you've defined your goals, you say, all right, now I'm ready to get started. I know what my time horizon is. I know what the reality of how much I can invest is. Where do you get started from there?
Yeah, I think there's a ton of great tools. I would find the experts, right? Go to credentialized places to get information and learn. I really strive for people to become curious in investing and learn and use the tools. We have a great value prop within our JP Morgan experience that allows you to explore ideas and think about what could be next. Tap into the analyst ratings, tap into CIB research pieces that might be great for you. There's also lots of screeners and different kind of news articles that you can read to get smart about the risk you're taking.
You know, it's interesting when you were saying stay curious, it naturally popped into my head that curiosity finds community as well, and vice versa, in that, you know, there are more forums that people tap into now where they may not feel like they have a financial advisor to lean into, and they go to perhaps social media. How do you strike a good balance between saying, okay, I've got this professional person that I know is, you know, going through their own charting on a day in, day out basis, and it has some know-how in managing several different accounts, versus the community where you're discussing and tossing around ideas? How do you kind of strike a good balance there?
Yeah, I think it's a good question. You know, there is many sources where you can get information and ideas.
Yeah.
The next place you need to take that, though, is validating those ideas, right? What criteria makes that company, that index actually make money or lose money? And be aware and comfortable with that. And so use the tools that are available, but use all of those destinations for inputs, but not really the golden source for where you transact.
There have been several moments this year that investors can really kind of point to and say, okay, that changed how I might invest, whether that is one of their favorite names, Chipotle, for instance, seeing a stock split, or maybe it's a theme that's taken off. What are some of the ways to stay grounded even when you do have major events like that happening, either in single names that you enjoy or themes that have really caught your attention too?
Yeah, I think it is really just looking in and staying, keeping the pulse on your portfolio and the ideas you have. There's great tools in self-directed like watch lists, like alerts that might draw you back in when you may be paying attention to something else in life, right? And so it's your money. Take the time to care about where you're putting it at, and use the tools that are available to you to help do that.
All right, I have too many alerts to fire off on my phone, so, and a lot of investments that I haven't made yet. Just continuing to keep an eye on for right now.
Awesome.
Thank you so much. Andrea Finnan, who is the JP Morgan Wealth Management Head of Self-Directed Investing. Appreciate the time.
Thank you.
Absolutely. Well, turning now to our new weekly segment, Tech Support. We talk to experts about the latest tech headlines and what they mean for you as both a consumer and an investor. And today we're talking about search engines. Google is such a dominant force that searching something up online is commonly called just Googling, no matter what the site someone is using, actually. But recently, users aren't feeling so confident in Google's ability to find what they're looking for. Interestingly, here now, people on social media and journalists finding in their usage that Google has, quote, gotten worse And as feelings toward Google sour, Reddit is one reaping the benefits here. Worldwide desktop and mobile visits to Reddit jumped 39% year over year in May, while Google visits decreased 2.2% in the same period. That's according to SimilarWeb. So, why are people choosing Reddit and how well does it really work? Joining me now is someone who compared the two personally, Anne-Marie Alcantara, who is the Wall Street Journal personal tech reporter. Anne-Marie, great to have you here in studio.
Thank you, thank you.
Absolutely. Okay, so you took a look at both of them just to see which one actually gave you better search results here. Walk us through what the research really showed you here.
So it was kind of a tie.
Okay.
That's what ended up happening. So it's not really clear cut, but basically for a week, I spent my life Googling, as I normally would Google, and then adding Reddit to the end of my Google searches, which is what people commonly do. And so for things like restaurant recommendations, Google was the best because it showed me the menu and images, whereas Reddit was telling me not to eat there, which is not useful. Yeah.
It's like getting straight to the reviews that Google would also compile as well, but perhaps a little bit more of that kind of personal flavor peppered in too to some of those search results. I mean, as we're thinking about both of these different platforms, one of them we know has a lot of advertisements that take up above the fold results, and then you eventually get to the nitty-gritty, the things that are valuable, what you went there for, versus another which is very much leaning towards kind of the reviews, the personal community kind of side of things too. So how does this change where people might tend to search in the future too?
So we're seeing this happen across all social media sites, not just Reddit, but people are turning towards more real experiences, things that feel like it's coming from a person versus a publisher or a journalist that they might not know. So people are just looking for that, extra personality, something that feels real versus just another website that tells them what to do.
What is the best way to use Reddit to search? Because I run my own searches as well. If I'm going on a vacation and I want to know, okay, what are the top spots that I have to visit when I get to this destination that I've never been to before? What are the top ways to search on Reddit right now?
So most of the people I spoke to for the story said to definitely add Reddit to the end of your search.
Okay.
You don't have to do anything fancy. You can just do that and it'll pop up on your Google. And then, go through the results, see what's been upvoted, which is the term on Reddit, that basically means this is the comment that won on Reddit, on that Reddit post. And usually that's the best comment you'll find for whatever you're looking for. But also, it is social media. So people tend to write about their bad experiences the most. So if, let's say you're going on vacation and you wanted to go visit a museum, if there's a bad review, maybe take it with a grain of salt because you might still enjoy it and this person just might have not liked it a lot.
What are other social sites that people are using to find the results that they're looking for when they run a query, essentially?
Pinterest is a big one, thinking of your vacation search history. TikTok, of course, YouTube, Instagram. People want to see what the place even looks like, what this museum, whatever it might be, product, et cetera, what it might look like in real life. So it's across all social media.
Absolutely. Thank you so much for breaking this down. All right, I got some searches to run here, so we got a jet. Thank you so much, Anne-Marie Alcantara, who is the Wall Street Journal personal tech reporter here in studio with us. Coming up, are you traveling for 4th of July? Well, guess what? You're probably not alone. We talked to Hopper's lead economist coming up about everything you need to know about the busy travel day. That's coming up. Whether you're hitting the road or flying high in the skies, Americans can expect a hectic travel weekend for this 4th of July. More than 24 million people are expected to fly out of U.S. airports from July 3rd until July 9th. That's a 7% increase from this time last year, according to Hopper data. And here to weigh in on the busy travel week ahead, I'm joined by Haley Berg, Hopper lead economist. Haley, always enjoy our conversations here. They're aspirational, they're real, and we got to dive into some of the nitty-gritty data here on the expectations. What are we expecting for this July 4th week and holiday, kind of all in when we think about travel?
We're expecting most travelers to have gotten really good prices, which is the best news about this 4th of July weekend after a couple years of very expensive summer travel. Airfares down 18% in the US. Hotel prices are very much in line with previous years, as are rental car prices. So those travelers who are getting away are definitely able to expand those travel budgets into things like activities and maybe some nice dinners out rather than spending as much on accommodations and flights.
Okay, so let's talk about some of those last minute deals that might be able to save people some money on their trips. What are some of those deals that people should be leaning into or looking for?
If you're planning to fly and you haven't booked yet for 4th of July, you do need to book now. It's pretty late in the game here, but there are still deals available. I just looked this morning. We're still seeing Nashville, Charleston, Myrtle Beach under $100 round trip over the long weekend from major cities like New York. So there are deals available. You need to be flexible. Fly on the 4th. That's when airfare will be the cheapest and lines will be the shortest. And try to come back midweek on the 7th or 8th, midweek following the long weekend, fewer crowds, and that's where the best deals will be.
Okay, so with this type of volume, let's be real, Haley. We can expect some travelers will face a few disruptions this 4th of July weekend and the travel weekend upcoming. What should they do if their flight gets delayed or canceled?
You're absolutely right. Over weekends like this, where there's so much capacity flying, oftentimes we do see spikes in delay and cancellation rates, whether it's weather or just those domino effect delays. If you are impacted by disruptions, the best thing to do is actually plan ahead before you even get to the airport. So know what other flights are headed to your destination on the same or next day. If you can't fly out of the airport that you are planning to, are there regional airports nearby? Could you rent a car and drive on to your destination? It's also important to know if you haven't booked yet, book the first flight of the day. Early bird gets the worm. If you leave before 8 a.m., you are less likely to be delayed or canceled by about half.
It's interesting. I mean, it seems like there's always some type of disruption on the way to, I don't know, airports in New York like JFK, where it's just like an act of God will keep you from being able to get there to make your flight on time, or at least before you're supposed to check your bag to go on your flight. All these things considered, and I know it sounds like a personal problem, but there are other people that have brought this to my attention. So where should you be leaning into travel insurance policies as well that could cover you in these events?
It's really important when you're planning a trip and making a substantial financial investment, especially in these bucket list trips a lot of Americans are taking to Europe and Asia. It's important to look at what protection insurance products are available. We're all, I think, pretty familiar with traditional travel insurance. Can help you if you happen to break a leg, get sick in another country, help cover medical expenses. Sometimes we'll cover things like lost baggage. But there are more specific types of protection products that are really important for travelers in the summer months and over the holidays if you're thinking ahead. And those are disruption assistance tools. If you're delayed, canceled, you miss a connection, you can rebook yourself immediately with the value of your ticket on any available airline. So you're not beholden to the airline that you had flown on that maybe doesn't have another flight out that day or for the rest of the week.
All right,
we offer these on the Hopper app, but also on some of our partner airline websites, Capital One Travel, so you can find them where you are booking travel already.
Haley, appreciate the insights. As always, some actionable tips, and also thanks for enduring my travel rant a moment ago. Haley Berg, Hopper lead economist. Great to see you, Haley.
Great to see you too.
Thanks. Let's do a final check of the markets here, everyone, as we are closing out this 11 a.m. hour. The Dow Jones Industrial Average flat, barely to the upside. S&P 500, same. Nasdaq Composite, up 0.4%. That's it for Wealth. I'm Brad Smith. Thanks so much for watching. Market Domination starts at 3 p.m. Julie Hyman and Josh Lipton got you covered there. You don't want to miss it.